It's 9 a.m. here in New York City. I'm Shauna Smith alongside Miles Udlin. This is Yahoo Finance Live, and here's what we're watching this morning. Well, stocks lower for a second day amid fading optimism for aggressive rate cuts. The decline coming ahead of fresh jobs data and the minutes from the Fed's December meeting later today.
And the biggest theme from 2023 continues into the new year. Tech leading lower on Tuesday after leading way higher last year. Apple stock suffering its worst day since November after a downgrade at Barclays on concerns over iPhone sales momentum.
And a tough road ahead for Tesla potentially here. Bernstein warning that shares of the EV maker could plunge 40%. The analyst behind that call saying that lower margins and lackluster demand are big headwinds for the stock this year.
So markets started 2024 with a bust. Traders closed out 2023 on a high note. Investors were greeted with one of the worst opening days for global stocks and bonds this century, while the Nasdaq logged its worst first day of the year since 2016 after a 40% rally last year. Now, according to Bespoke, a recession can't be ruled out, and 2023 may have been too good to be true. Now, Shauna, when you kind of think about the good and the bad of the last year, or really where we stand, kind of the way Bespoke framed it is, who knows what happens in 2024? I always appreciate these outlooks, but you don't really know. But on the negative, let's start with the negative. And I think something that they called out in their note, this was out late last week, is that sentiment had gotten so high at the end of last year. And, you know, there were kind of jokes, you'd do tax loss selling last year. You could do your tax loss selling at the beginning of the year, you know, if you want to square out your books that way. But ultimately, I think sentiment around the market, sentiment around where we're headed with this tech trade, we're going to get into that later in the show. And really with rates, I think, is the big challenge for investors, because all of the hype last year, where could rates go? Well, the Fed told us most likely where they're headed. And now that really is like, okay, so you know, how do you trade that since you already, you know, it's already been quote unquote, maybe, depending on who you talk to, priced in to an extent.
Well, yeah, exactly. I think that's exactly it there, Miles. And you talk about some of the pain that we saw yesterday within some of those mega cap tech names. Now, the question is there more pain ahead? We're going to get into that. Bank of America was out with an interesting note on that yesterday from Savita Subramanian over there. But when it comes to some of the pain that we could see more broadly speaking in the market, there is this sort of a line of thinking out there right now that maybe we have gone too far, a little bit too fast, especially taking into account the rally that we saw at the end of the fourth quarter. Maybe investors are a bit too optimistic given the data that we're still giving out on the econ side of things, that maybe the rate cuts that they are hoping for from the Fed coming as early as March is a bit too optimistic. So taking all of that into consideration, we are seeing a bit of selling once again here, at least with taking a look at some of the futures performance here this morning ahead of the open. We could see a continuation of the selling that we saw yesterday. The question, though, is to what degree is that selling going to look like and where that pain is going to come from, whether or not that's going to be mostly coming from those leaders of last year, those mega cap tech names.
Yeah, and I think, you know, the last point on this is that you have this macro trade, like a very obvious macro trade about what is the Fed going to do. And you can go through and you know, Nick Colas over at DataTrek this morning had a great note talking about how the 10-year has really been the driver of the market over the last couple of years. But, you know, the big trade or the big conversation, particularly from stock strategists, you know, Savita, some of his Brian Belsky, is the way that equal weighted, you know, the equal weighted S&P is more attractive. Or you look at everything X the Magnificent Seven, the S&P 493, valuations there are pretty much in line with historical averages, trading about 15 times, you know, forward earnings. On average, the S&P trades about 14.8. So things look a little bit better on that basis. And I think, you know, Bespoke flagging that as a potential positive for investors in the year ahead. So it's kind of this dichotomy where you have a very, like, one conversation, the macro conversation, I think it's a little bit less constructive for investors. But if you want to do, which all strategists want to do, the stock picking game, the theme picking game, that has a lot more positives, I think, for you know, folks looking quote unquote under the hood. I don't know if the S&P 493 is under the hood really, but you know, we'll call it that for
it was in 2023.
This exercise. Yeah, that's right. Yeah. Anything that's not Nvidia, I guess, is, you know, a small cap.
Anything that's not, yeah, exactly. I'm not one of those seven favored there from investors in 2023. At least was under the hood to some extent last year. We'll see whether or not that continues to be the case this year. All right, well, let's talk a little bit more about what we could see from the Fed this year. Investors are getting the first bit of Fed speak in the new year. Richmond Fed President Thomas Barkin saying this morning that while a soft landing is, quote, increasingly conceivable, the potential for additional rate hikes is still on the table. Now, the minutes from the Fed's December meeting coming out at 2 p.m. Eastern time today. All eyes are going to be on whether or not officials walk back Fed Chair Jay Powell's dovish message to Wall Street last month. Now, if they do, the market's desire or maybe confidence in aggressive rate cuts could potentially be on the line. We want to bring in Matt Luzetti. He's Deutsche Bank's chief U.S. economist. And Matt, I'm just going to point blank ask you here. What are you expecting the Fed to do this year in terms of the timeline of those potential rate cuts?
Yeah, so our baseline is that the Fed begins to cut rates in June, that they cut rates by 175 basis points over the course of the year. That's a little bit delayed relative to market pricing. At the moment, it was quite aggressive relative to market pricing, just a month or two ago. But I think key to our view is that you get inflation data, which is a little bit firmer over the next few months. That gives the Fed some pause for a rate cut by March. But also that the labor market deteriorates more than what the Fed anticipates, which allows them to cut rates more aggressively over the back half of the year. That's our baseline outlook, but we've seen certainly the market move pretty aggressively relative to that.
Yeah, it's an interesting call because a lot of people are looking for a continuation, like a smooth path for the Fed, basically, right? We rose, we kind of gradually got to the peak in 2023. 2024 will gradually come down. What specifically are you looking for in the labor market, call it third quarter of next year, that's going to make the Fed aggressively move to cut rates?
Yeah, I think what we typically see is the Fed, goes up kind of gradually and then comes down very quickly, takes the elevator down in terms of rate cuts. And that's because they typically respond to recessionary type dynamics where they get worried about the labor market softening, consumer softening. And so that's what we're anticipating. But it's not nearly as bad as a typical recession. So we have the unemployment rate rising to about 4.5% by the middle of the year. And if you have that plus an inflation rate that is very close to the Fed's target at that point in time, I think that the Fed just has ample scope to cut rates because they're already at 5.3% on the Fed funds rate. They think normal is closer to 2.5%.
And I guess in thinking about the labor market, we're going to have the jobs report on Friday. "Quote unquote," most people, it's all about the non-farm payrolls number. Are there other indicators that you guys are going to be focused on as we get into March, April, as we kind of get towards this move towards 4.5% on unemployment?
Yeah, I mean, obviously the unemployment rate is really important there. So it was 3.9% just 2 months ago, came back down to 3.7%. So does that retrace some of the improvement that we've seen? Going under the hood of that, we look at something called permanent job losers. So this is why are people unemployed? That's been rising actually pretty substantially. It's higher than it was in 2019, showing you some deterioration in the data. The other thing that I would look at is the breadth of job gains. And there's a really interesting data point. So if you take out leisure and hospitality, education and health, the private sector has actually contracted in terms of jobs over the past 6 months. So it's been very narrow, very concentrated in terms of a few sectors. I think that'll be important for as we look at the labor market over the year ahead.
Matt, how worrisome is that?
Look, you don't see that ever outside of recessions. Yeah. Now, there's a lot of indicators right now that you don't see ever outside of recessions, the LEI, Leading Economic Index, some of the survey-based indicators. So I would still say, look, we're producing a good amount of jobs. We've seen the hiring rate stabilize. The quits rate is stabilized. We'll get the jolts in about an hour. That'll be a really important read into the data. It's somewhat worrying. You do want to see broader job gains because it just gives you greater resilience from the labor market. But so far, it clearly hasn't spilled over into something more negative for the labor market. And
just looking back at 2023, do you think that what happened in the last, call it 3 months of the year, is considered a pivot from the Powell Fed? Like, how did you read kind of the progression that the Fed took last year in terms of being more aggressive in the first half of the year than most people thought, and then really kind of finding this magical moment at the end of the year where seemed everybody was happy, at least investors were all happy with everything Powell first and foremost was saying? No doubt it was a pivot. I think you had the Fed that was very worried about inflation risks for much of the past 2 years, showed that inflation risks are much better balanced. We saw that from the December meeting. And that makes sense given the data that we've seen over the past 6 months. Core PCE is actually below 2%. So the Fed on shorter timeframes has achieved their objectives already. They've seen the labor market come into much better balance. So I think that's been a very positive development from their perspective. And I think if you see the labor market close to their objectives, you see inflation getting close to their objectives, they are not going to think that a 5.3% Fed funds rate is appropriate. So the discussion pivots to thinking about rate cuts. We'll hear some discussions about that in the minutes today. I don't think it will sound as dovish as Chair Powell did at the December meeting. We've heard that from a number of officials yet. But the reality is if inflation keeps coming in low and if the labor market softens a bit here, the Fed will be transitioning towards reducing rates. All right, Matt Luzetti, Deutsche Bank's chief U.S. economist. Really appreciate the time. Thanks for having me. All right, tech seeing a painful start to the year. The Nasdaq falling 1.6% to kick off 2024, dragged down by an Apple downgrade. Over at Barclays, Yahoo Finance's Jared Berkeley and Josh Schaefer join us now for full team coverage. Jared, let's start with you and talk a little bit about what we saw in the tech trade yesterday, anything that we're seeing this morning, and kind of what you made of that move really just a clean reversal of everything that worked in 2023 stumbling out of the gates in 2024.
Miles, you hit the nail on the head there. Quite the reversal. Nasdaq Composite up 43% last year, Nasdaq 100 53%, and then we lose it yesterday. And by the way, the Dow closed at a record closing high for the Dow. So really unusual price action. Let's take a look at the Wi-Fi Interactive here. I just want to show you the Nasdaq Composite. We have been in a very steep uptrend, and let me just draw a line here. This is not sustainable. Anytime you have a trend line that's steep and you have a pennant formation like that, it's going to break. And the big question for investors is this going to get continuation? Let me just plot Apple real quickly because I have a couple thoughts about that. Let's go to a 2-year look. You know, it's interesting because 1 year ago in January, we also had some bad news for Apple. There were doubts about its iPhone cycle and customer demand, and it was down about 4% that day. So kind of a very, I guess, echo-ish situation, if I can just make up that word. But here we have the makings of a potential double top here. I think it's way too early to start talking about that. You need at least a check of the neckline. But you take a look at all this red, that's something that is a big departure, and that's kind of the bottom line like you were talking about, Miles. Let me just show you the overnight price action, staples and healthcare. Those are the two leading sectors. And then I'm going to take off these pre-market quotes and show you what's happened over the last 5 days. Healthcare is the leading sector, up 2.8% versus utilities. And I think what could be going on here, I don't necessarily think this is the end of the bull market as we see it. Could be a little bit of rotation in here. Now, here's healthcare and tech, what they did yesterday. This one up top is healthcare, tech down here, and you can see over the last 5 days, here's what happened with that big divergence. But you typically see this in a rally. I think the question is healthcare too defensive? Are we going to see staples rise as well? Well, as I pointed out, staples was leading yesterday. So this is just probably a yellow warning for the markets here. And I just want to plot Bitcoin too. This kind of ties into the whole tech trade. Here's Bitcoin over the last 5 days. Let me just pull up an overnight chart. You can see it's given back some gains here. And over the last 5 days, I call this chart formation easy come, easy go, because we just hit supply up there and sold off. But you'll notice in the 3-month trend, we are still within almost this trend channel. So a little bit of negative action here, but nothing too concerning just yet, guys.
Jared, we'll call that the Bohemian Rhapsody trade for Bitcoin.
I love it.
There. I want to talk a little bit about the Dow specifically, and of course, for those playing at home, United Healthcare has the largest weight within the Dow. So the move we saw in healthcare yesterday certainly influencing that. But I'm curious, if at all, what you make of the healthcare action and really what we've seen from healthcare over the last year. It did not participate in 2023. You mentioned that it's a more defensive name, but is there much more that you're reading through on the performance of the Dow and what that might say about the overall market health, or are we just maybe making too much of what remains the Santa Claus rally, technically speaking? Yeah, healthcare is a really tricky sector, and that's because you have these giant stalwarts. Let's go to the Wi-Fi Interactive here, and I'll just chart. Let me put up our... There we go, our RX heat map. And you can see over the last year, I'm going to put that time frame on right now, you have haves and have-nots. So you take a stalwart like Pfizer, huge company, that's down 42% over the last year. Eli Lilly, thanks to some of those weight loss drugs, that's up 60%. So same for Novo, that's up 50%. But then remember mRNA, Moderna, that was a poster child trade of the early pandemic, and that is one of the worst performers in the S&P 500 last year. So biotech is a lot different than regular pharma, and there are just a lot of different dynamics going on. I think it's too bifurcated to make any generalized conclusions just yet.
All right, Jared, thanks so much. Josh, let's get back to the conversation we were having in terms of the leaders to the downside, or the underperformers, I should say, when it comes to tech. Obviously, massive decliner yesterday. Some new notes out on the street in terms of maybe what those future declines could potentially look like.
Yeah, so Bank of America pointing out, they called it a street consensus, and the street consensus being broadening out. So not necessarily, and that's the understanding of the call here, I think, in general for 24. There aren't a lot of people saying don't own tech stocks and don't own the Mag 7. They're saying maybe there's opportunity elsewhere, and at some point, that means money has to come from somewhere, right? And so if you're going to invest in those other 493 stocks, maybe you sell the stock that was up 250% last year, or at least take some profits from it. I mean, you look at that Mag 7 chart from last year that we love to show, there's some impressive gains in there. And so if anyone is profit taking in there, it might make a little bit of sense. But Bank of America actually did sort of make sense of how they think that call, at least for January, might not be fully correct. And I found that sort of interesting. They're pointing out something like a passive index fund actually bases their inflows on market capitalization. So if they're just sort of running a traditional model, I can see Miles' head spinning, but they are high market caps, right? So at some point, some of the money could just naturally flow into there, basically on the model, and not necessarily because it's the play.
Yeah, I mean, I think, and you know, Josh, you and I spent a lot of time over the last month thinking about the consensus call for 2024, but really we just talked about what the consensus call for 2023 was, right? And that call was there'd be a recession the first half of the year, stocks would go down, and then stocks would go back to flat for the year, which didn't happen at all. Stocks, you know, ripped out of the gate, and we were off to the races. What's notable about 2024's consensus, and I think we're really seeing it in the last couple of days, the way people are discussing the move in tech, which is, it's fine. Right? We actually do need to catch up with all these other names because we saw, again, you go back to that Magnificent Seven chart, Meta's up 160% last year, Nvidia triples, I think. I mean, these companies are adding hundreds of billions, in Apple's case, you know, nearly $1 trillion in market cap to the biggest companies in the market. So everyone is saying, well, you got to do something else. You should buy like something smaller, or I mean, you could just pick a company that's got a $100 billion market cap instead of $3 trillion, right? And it counts as small. But I am very curious to see, and you mentioned the flows part of it, how that manifests itself. Because if there's one thing, and you know, you think about Mike Hartnett over at B of A, if there's one thing he loves more than anything, it's like, oh, well, everyone says this, so it's definitely going to be the opposite. And for sure, the consensus trade is buy anything that doesn't have Magnificent in front of it.
Right, yeah. And so you wonder, maybe you just buy more Magnificent, right? You're saying the opposite plays out?
Well, I didn't mean to twist myself into that. I didn't mean to big brain it that much, but I guess we kind of got there in the end, right?
Yeah, I thought it was interesting just looking at the charts overall too. You mentioned it earlier, thinking about that cap-weighted S&P 500 though, right? And like really the trade that we've seen just kind of played out a little bit more to start the year in some ways, depending on what area of the market you were looking at. But that cap-weighted index has outperformed the normal S&P 500 for over a month and a half now.
Well,
and that's what people were calling for, right?
Isn't that
the healthy rally we wanted? Didn't we want this?
The interesting part about the 24 consensus is that it actually happened between Thanksgiving and Christmas, and now it's over. So we got 24 at the end of 23. We got to figure out something different over the next couple months.
We'll see, guys. It's only been one full trading day. You can't call it yet.
I just did. We just did. It's over.
2025 price targets. Here we go.
Year's over. Just like the day ends when the market opens, the year is over the second day the market opens. So
you heard it here first.
Happy New Year 2025.
All right, Josh, thanks so much for that uplifting combo here. All right, well, Tesla shares falling in pre-market trading after Bernstein warning of a, quote, tough road ahead for Tesla. The analyst behind that call warning that shares could plunge 40%. Madison Mills is on the floor at the New York Stock Exchange with more on what we're hearing from Bernstein. Maddie.
Yeah, so this is not necessarily a huge change from what we've heard from this analyst previously. He's been pretty bearish on Tesla over the course of 2023, even back in December, saying that this was the best stock to short heading into 2024. But having said that, reiterating that $150 price target, and that would be a 40% plunge for this name. Now, the thinking here from Tony is that volumes and sales are going to continue to be a challenge that are going to put pressure on Tesla's margins, and reiterating that again after the news that we've gotten from Tesla this week regarding how those sales have done. Just a little bit of a beat on those electric vehicle deliveries, but not enough to see a lot of upside from the market reaction here. I'm just taking a look at this stock performance pre-market, down just about 1.5% almost in the pre-market trade. But Tesla not having that bad of a day yesterday compared with some of the other big tech names that we've seen. So we'll see whether or not that continues to be the story in their trade that dominates this name today.
Now, Maddie, also related to Tesla, yesterday we saw some news out of BYD, and really, the fundamental story here in the overall EV market changing a little bit. Tell us more about that.
Yeah, so BYD taking over as the biggest EV name here, topping Tesla's sales and deliveries as well. But having said that, Tesla did perform very well in China. Their year-over-year deliveries, sales rather, at 40% growth year-over-year. So that's obviously a win for them. Dan Ives this morning saying that it's just that BYD is a beast in China, so it's difficult for Tesla to match up there. But from an investor perspective, look, they're not investing investing in Tesla's returns in China. They're investing in Tesla as a global company. So can they go all in on this narrative that Tesla did do well in China, even when you look globally at this name and you see that BYD is taking up more of their market share? But as always, Miles, it depends on where you look for the data, right? If you look at Ford and GM cutting back on their EVs, you have to wonder whether American buyers are saying to themselves, look, do I want an EV or do I want a Tesla? And that could be a boon for them this year.
All right, Maddie Mills, live on the floor of the New York Stock Exchange. All right, let's take a look at Disney shares. Stock is up slightly in pre-market trade after activist investor ValueAct, stock is down 0.2%. ValueAct and Disney reaching a deal that will see Disney and the investor share information so that ValueAct can consult the company on strategic matters. Now, ValueAct is also pledging to support Disney's slate of directors at its shareholder meeting later this year. The deal comes as Disney continues to fight off a proxy battle with Nelson Peltz, who has nominated his own slate of directors to the board. He also has the support of former Marvel chair Ike Perlmutter, one of the company's largest outside shareholders. Now, at the same time, Reuters also reporting on Wednesday that Blackwell's Capital has nominated 3 directors to Disney's board. Now, we do have a problem with scale here. Blackwell's owns about $5 million worth of Disney stock. Peltz owns closer to $4 billion worth of Disney shares. ValueAct's stake in the company remains undisclosed, according to the Wall Street Journal. One can imagine, though, Shauna, given that they have reached this detente with Disney, that the stake is sizable enough that that ValueAct, putting their weight behind Disney's slate of directors, is enough to matter here. But I think it shows, I guess, the seriousness, really, of the fight that Bob Iger has on his hands, that he's calling in an ally. ValueAct now is, going to help Disney do the legwork among its investor base to make sure that it keeps its planned director slate intact as we get towards this crucial shareholder meeting later this year.
Yeah, I think this just shows how much pressure Bob Iger is under right now. We know Nelson Peltz, this is the second time he's targeted Iger since he has been back as CEO of the company. They're pushing to make some changes, obviously wants to cut costs here, compensation changes going on just a bit in terms of what they want to see, governance, succession issues, just among the list that Nelson Peltz and his team want to see changed at Disney. The fact that they are calling in the help of others like ValueAct is really just the latest twist of this ongoing saga that we have been covering now for over a year. Whether or not they are able to successfully fend off Peltz and please him here for the second time, that is a big question that investors are facing right now. Clearly, Disney is up against a number of challenges since Iger has returned. They need to figure out how to stem their losses in the streaming business. They need to figure out how to boost their parks business more going forward. A number of the changes or a number of the issues that Iger himself has outlined during the last several earnings calls. So how quickly he can act and how quickly he can get investor shareholders back on board is the question that I think many on the street are asking themselves right now.
Yeah, I mean, I think, in Iger's view, he's come out, he's done quite a lot on the cost-cutting side. No, he's done a lot on the cost-cutting side, and I think there's a certain level at which, you as the CEO are sitting there like, okay, but now we need to run the business. Yeah. I've cut out, it's going to be $7 billion in costs, I think, over the next couple of years. But there's still, it still takes a lot of money to put on the college football playoff, to put these movies out. And I think there's a level at which you as the CEO are trying to find a way to say, all right, enough. Let me run the business. And I think, obviously, look at, read through on today's news, ValueAct appears to be the investor that will get on board with Iger's plans as we go forward here.
It certainly is a story that we will continue to track here at Yahoo Finance. Again, shares of Disney now under just a bit of pressure in the pre-market. We're going to take a quick break, but coming up next, Wall Street calling out winners and losers in fintech and the bank stocks at the start of the year. We've got the details on which banks are at the top of that list next.
All right, analysts across the street this week weighing in on the financial sector coming off a tumultuous 2023. Now, in a new note, the team at Wolfe Research named JP Morgan a top pick in the banking sector and also upgraded shares of Citi to outperform from peer perform. The firm cited resiliency in net interest income relative to peers for both firms. And Wolfe isn't alone in talking up the prospects for Citi. Wells Fargo's Mike Mayo saying the bank stock could more than double over the next 3 years, looking for shares to trade north of $100 over that time. He raised his 12-month price target on the stock to $70 from $60 in a note this week. Now, Sean, I know you're going to talk to Mike Mayo later on in the program about this call, but certainly a lot going on with the big money center banks. And I think go back to 2023, such an interesting story. The very simple math here, and I've been told many times that this is not the right way to think about banks, but rates go up and your interest income is going to go up. So it's good for the banks. But I think as we really saw with the regional banking crisis, of course, at the beginning of 2023, a lot under the hood with the balance sheet. Things are not quite that simple. And really, this is a way that I've heard banks describe, which I've been told is more correct. It's a levered play on the economy. So if the prospects for the economy don't look good, you've got bad news for banks. And I think Wall Street's starting to get a little more, let's say, complacent, copacetic. They're accepting of like the muddle through soft landing-ish kind of story, at least when it comes to investing in banks that we're looking at for 2024.
Yeah, I think you're exactly right in terms of the pressure that we could see or lack thereof on net interest margins. That's, of course, the crux of these two notes that we got out here over the last couple of days from Mike Mayo and also from Wolfe Research. But what was interesting to me was what Mike Mayo in particular, I know we're going to talk to him next hour, but what he had to say about some of the adjustments that have been made at Citi and the fact that investors are still so pessimistic about Citi up until this point, despite all the changes that Fraser has made over the last 12 to 18 months, despite the plans that she has also laid out, the roadmap she has laid out for the road ahead in terms of the restructuring of the bank, the layoffs, the priorities and what she sees for Citigroup here going forward, and Mike Mayo making the case that he actually sees Citi among the best positioned and in a position to almost double shares here over the next 3 years. So exactly why he sees that more favorable setup, we'll get a little bit more from him. But then you have Wolfe Research making the case that JP Morgan still looks very attractive at this point. All right, but let's talk about SoFi because it isn't all good news for some of those financial plays out there. KBW out downgrading SoFi to underperform from market perform. Now they're saying that they see stagnant technology development weighing on results. A lot of this goes back to origination growth, the lack thereof, slowing origination growth here from KBW, calling out CapEx constraints, calling out limited profitability. They think that that is going to handicap SoFi's performance here, at least in the first half of 2024.
Yeah, I mean, I think it also gets to, not breaking news here, the way that these firms differ, right? And that SoFi is about originating account, opening accounts, finding new consumers essentially to walk in the door and use their services, whether that's consolidating loans. They have obviously a huge student loan, payment part of that, high yield savings accounts, all these kinds of things. When you get into a money center bank, you've got all kinds of business lines, all kinds of levers. Citi's working on getting rid of entire geographies, which is not something that's part of the SoFi story. And so an interesting one there, looking at that sector into 2024.
It's certainly not an apples to apples comparison there. All right, well, let's get to the opening bell on Wall Street as we kick off the second trading day of 2024. And you can see some excitement there, optimism maybe, as we kick off the second day, hoping to reverse some of the losses that we saw to start the trading year. Now, we've got team coverage for you to break down today's action at the open. Jared Blickery joining us now here in studio. Madison Mills still on the floor of the New York Stock Exchange for us. But Jared, let me kick it over to you with some of the moves that we're seeing here at the open.
Yeah, another down day here. It looks like a little bit of continuation from yesterday. We got the Dow down about 0.25%. The Nasdaq, I'm not sure if it is, there we go. It's down 0.8% after that 1.5% loss yesterday. Let me get a quick check of the bond market and then I'll get into some heat maps. The 10-year T-note yield is up another 4 basis points. Climbing yields have been a headwind for stocks, just very broadly. And after this huge decline here, this might signal a trend change, but it is a little bit early to call call for that just yet. But I want to talk about the VIX real quickly. I'm going to be doing a deeper dive in the next hour. The VIX has been moving up as stocks has been moving up. So that's a little bit of a negative correlation. And what does that mean historically? I'll be going over that in 30 minutes. And then here's the ICE B of A move index, and not seeing a whole lot there. So let's get a check of the sectors. I was noting a little bit ago the outperformance of healthcare, and here we see healthcare and staples. Those are the two leading sectors. Energy also green. So this continuation that I've been talking about of the defensiveness that we've seen emerge over the last few sessions here, really just continuing today. Here's materials and real estate, both of those down more than 1%. And there's tech down 0.8%, was tracking the tech to healthcare ratio earlier. Here's Apple. Got to check a look at that. That's down about 0.4%. Alphabet down 0.6. NVIDIA down 1.7%. I want to close here by saying this is day 7, the final day of the Santa Claus rally, and let's see where we're ending up so far. Yesterday, as of the close, we were actually negative in the S&P 500, and if we were to calculate 7 days, as it stands right now, well, we're down 0.5%. This is an indicator, so it actually has predictive value combined with some other January indicators. We have to see how those roll out. Could be a negative year. And we'll have to see how Santa Claus plays out. If we end in the green today, probably going to be happy. And if not, well, some tears.
Oh, there you go.
Next year.
I'll inquire with the man on the North Pole just to see how he feels about this. All right, Jared Blickery, thanks for that. Meanwhile, Madison Mills live on the floor of the New York Stock Exchange. Maddie, Jared talked a lot about what's happening in the equity market, but the big moves today really happening over in the crypto market.
Yeah, Miles, Bitcoin just absolutely puking, as I like to say, this morning. If you take a look at Bitcoin tied to the US dollar, totally erasing some of those gains so far, taking out about $45,000 this morning. Prices tumbling by the most on an intraday basis since back in March. Now, this is, of course, ahead of the SEC's January 10th deadline to decide on a spot Bitcoin ETF. So that anticipation of that upcoming event might be part of this. We could be seeing heading into that day, a maybe buy the rumor, sell the news event as we get closer, but it doesn't look like that's what we're seeing today. Just to run through a couple specifics here, Bitcoin USD down 7.5%, Ethereum down 7.8% this morning, and we are seeing an uptick in volume if I take a look at the data on the Yahoo Finance platform right now. Again, though, I do want to anticipate a little bit of potential bullishness to come for Bitcoin. Bitcoin has rallied in 7 of the 8 past Februaries, and that 7 of the 8 past years in February, rather, and that is because of potentially some of the bonuses that folks get in February, able to put that money towards a little bit of asset diversification and putting that money towards a commodity like Bitcoin as opposed to some of the more traditional asset classes. So we could see that coming in up in February, but again, I think all eyes in the cryptocurrency space are on that upcoming SEC decision and whether or not we're going to see approval of that spot Bitcoin ETF to come. And that's part of why we've seen a lot of inflows into this space, maybe seeing a little bit of outflows today due to just the sheer amount of inflows that we've seen into cryptocurrency, guys.
Yeah, it's certainly been pretty astounding to watch there. Maddie Mills, thanks so much for giving us the latest there from the floor of the New York Stock Exchange. Let's talk more about the moves that we're seeing in equities. Big tech once again lower today. Now the move coming after yesterday's tumble, which marked the worst first trading day for the Nasdaq since 2016. Here with more of what we could expect going forward, we want to bring in Christina Hooper, Invesco's Chief Global Market Strategist. Christina, it's great to have you here. So I think investors are maybe a bit nervous about what the next several weeks, several months could potentially look like following yesterday's sell-off. What do you think?
Well, I don't think there's that much cause for concern because we have to look at the reasons why we're seeing that tech sell-off. First of all, we had a really strong rally, so it makes sense that there would be some digestion. The real catalyst, though, has been an increase in rates, and that's really about fears around the FOMC minutes coming out today, as well as the jobs report on Friday. Essentially, as well as we're getting a little Fed speak that's hawkish, more rates aren't off the table. But we have to recognize recognize that that's part of a process in which we are seeing this pivot occur. The Fed has a real reason, a genuine interest in tamping down the easing of financial conditions. So they're going to talk hawkish. We're going to naturally have jitters around any kind of data releases right now as we wait for that true policy pivot. So to me, this is a pretty short-term blip.
And Christina, in looking at 2024, you look back at last year, and one of your big takeaways is that it's really all about monetary policy and where things come down for the Fed. And I do wonder, is that, and we've talked about this a little bit in the office, is that something that is always the case, or is that just this moment in time? And how do you see that playing out, I guess, not just this year, but thinking over this full cycle?
So it depends on how old you are. I'm old enough to tell you that's not always the case. But if you came of age during the global financial crisis, it has been the case since then, really. Monetary policy has dominated and driven markets. And especially as we transition from an ultra-low, extraordinarily abnormal rate environment to a more normal rate environment, there's likely to be a lot of shall I say, volatility and uncertainty, and that's what we're experiencing. But I think that there will be a point where monetary policy won't have such an outsized role. We're just not there yet.
And I guess in thinking about the markets over the last couple of years, a lot of folks were noting at the end of December, go back 2 years, it's kind of flat. Like it was sort of, we went all the way up, we came all the way back down, we made it all the way back. And I'm wondering, over time, looking at, style selection that investors can have within a portfolio, is that really just a reminder that, do your 10-year CAGRs, your 20-year CAGRs, like that's how you have to think about things? Like, I know it's the big pitch, you got to be diversified, but you have to look at that timeline. Otherwise, you're just going to be sitting here at this desk worrying about every 2-day move.
Well, that's the point of diversification, is that it makes you worry a little less. But certainly there are going to be areas that perform well for years. We've seen technology be on a juggernaut, but when it's down, it's really down, and it's so nice to see other parts of the portfolio that can soften those blows.
Christina, how much is riding on earnings growth here for 2024, just in terms of the expectations, given the lofty valuations that we're especially seeing in some of those larger cap tech names?
So, it's interesting. If we talk about valuations, yes, they've gotten stretched. But if we were to drill down, it's really a sub-segment of the market, and it's largely tech, as you pointed out. And there are other areas, like small caps, where valuations look rather attractive. So if we think of 2024 as a period for the market of broadening, then I think we're more comfortable with the idea that valuations are going to differ. Now, I think it's also important to point out that valuations are not predictive typically in the short term. So we can, winners can run for a while, high valuations can run. My view, to answer your question around earnings expectations for this year, my view is that we can see a continued rally in stocks driven by multiple expansion as rates go down. It's not going to be, I think, a big earnings story in the near term. And hopefully markets recognize that. I don't think we're going to be positively surprised by earnings in the near term.
And I guess we'll get you out of here on 2024. Maybe something that you're thinking about or that you see as a possibility for in the markets that maybe investors aren't building into their base case. We've talked a lot on the show already about the broadening, about where macro goes. Are there other things that you're thinking about for the year ahead?
Well, one kind of key component to many people's portfolios as they enter 2024 is an overweighting to cash. I mean, that's a reality that we've seen in a variety of different statistics. Now, I think it's important to have some exposure to cash. That's part of being well diversified. But for those that are overweight cash, it is time to look for opportunities. And I think that it's not just going to be about equities. I think we're going to see a real move towards fixed income. Investment grade credit, and even emerging market debt, going long and locking in those high yields while we still have them.
All right, we'll leave it there. Christina Hooper, Invesco's Chief Global Market Strategist. Appreciate the time.
Thank you.
All right, well, Wall Street continues to get more bulled up on NVIDIA. Stifel adding the company to their best ideas list for 2024 ahead of this AI cycle. We'll bring you the analysts behind that call coming up next.
We're here in Las Vegas, Nevada, outside of the Sphere. It's the massive music and entertainment venue that opened a few months ago. But the real reason we're in Sin City is for CES 2024. It's one of the largest tech shows on Earth, and we're going to be bringing you all of the news innovations and ideas out of.
Howie, hold on. We're not in Vegas, man. We're still in New York. And that's not the sphere. It's a cube.
I'm gonna miss my flight. Oh, taxi! Don't miss Yahoo Finance's coverage of CES 2024 in Las Vegas.
Analysts are still feeling bullish on NVIDIA after the stock climbed over 200% last year. Stifel is one of those names and doesn't expect the AI momentum to slow down anytime soon, calling the chip stock a, quote, best idea for 2024. We want to bring in the analyst behind that call, Ruben Roy. He's a Stifel applied technology analyst there. Ruben, it's great to have you here. So I think a lot of people are asking what exactly the gains could look like here for NVIDIA, at least over the next 12 months, given that massive rally that we saw last year. So what's the catalyst here for that upside to continue?
Yeah, it's a great question, and thanks for having me. So we put out our trends report, the tech team at Stifel yesterday, and top 10 trends. We do this every year, and really it was about AI, not surprisingly, but it was more about the broadening of AI. Last year, it was a lot about NVIDIA and GPU clusters and this massive dollars being spent by the cloud service providers on building out training networks. But when you look past that, AI servers, AI PCs, there's a lot of AI innovation and applications coming behind, right? And when we looked at all the companies that could potentially benefit, guess what? NVIDIA ticks all the boxes, right? So NVIDIA is still playing in the clusters, we think. There's still going to be an investment cycle continuing for AI training clusters. But when you look beyond that, we do think that if you think about AI servers that are going to be doing the next step of AI, so we're training last year, training this year, then inference, where are we going to make the money, where the ROI is going to come from? And NVIDIA ticks those boxes. So we think it's going to be a good year. Numbers went up massively last year, but there are different layers of NVIDIA's AI strategy. You've got the chips, the hardware, which is the biggest piece, but then there's networking behind it that networks all these clusters together. And probably the most important piece that I think investors really will start thinking about this year is software. And NVIDIA came up with a software stack, CUDA, that is the ecosystem of AI right now. And if you look at Apple and iOS, the way we're thinking about it is if you can win the developer, you're going to win the hardware. And so I think that's what the next stage of the NVIDIA story for this year is going to be.
Yeah, and I'm curious. I'm wrong on this basically, because I was reading through your note and I'm thinking like this cycle is very different in that we have to go back to like a hardware investment cycle, like a lot of money spent on stuff. And then we can get to this kind of software deployment layer that we really talked about in the 2010s. That was the moneymaker last decade. Is that a trend, one, that like is actually happening? And then two, is that something that investors need to reorient their thoughts around? Because tech for so long became, well, you got to find something with 90% gross margins and buy that. And it doesn't really feel quite the same way with the AI investment cycle.
Yeah, and well, I think it will be. And it's a very interesting point because NVIDIA's gross margins are best of breed, essentially. A few companies in the semiconductor space have gross margins in the low 70s, and NVIDIA is there today. Software and other aspects of the story are driving that. But the software story is important, right? Because everybody else is sort of on the outside. If you look at competitors like AMD or Intel, they're embracing this open ecosystem. Actually, this morning, Intel had an announcement that they're investing in an AI company, essentially, for generative AI software and software stacks for enterprise customers. I think that's the right move, and I think you're going to see a lot more of that. But in our view, NVIDIA is way ahead. And so as you think about software and services, NVIDIA ends up being, in our view, the first semiconductor company that seems like they've figured out how to monetize that.
Ruben, put the risk in perspective for us, just in terms of the crackdown that we're seeing from the U.S. towards China. Lots of questions about what exactly that could look like there for NVIDIA. I know it was one of the risks that you listed here. Within this note, how big of a risk is it really?
It's unclear. Yeah. No one knows. So, to date, NVIDIA has been able to circumvent some of the export restrictions by downsizing, if you will, the chip performance. I don't know if that's really in the spirit of the law, and we'll have to see where the spirit of the law ends up, taking us. But I am an optimist, and I do think that NVIDIA and the U.S. government and other chip companies in the United States are going to find a way to work with the Chinese. I think there's a lot more going on in China outside of bad actors. I think there's a lot of commerce companies, et cetera. And I think at the end of the day, the semiconductor ecosystem is a global supply chain. And we all have to figure out how to work together. And I think that's going to end up driving revenue growth and profitability for a lot of semiconductors companies in China going forward.
We've talked a lot, your note is really just about like the AI, the tech behind it and the way that's changing things. I'm curious the conversations that you've either had or anticipate kind of having with investors who are saying like, well, the Fed's doing this, so it's going to move tech. Like how you think about the trade and the setup maybe, as some traders might think about it, versus the fundamental story that we're really discussing here.
Well, I guess, we're hearing a bunch of rate cuts are priced in at this point. But if you look at valuations across the semiconductor group, and NVIDIA is a great point, numbers went up so much last year. NVIDIA is trading at a discount to a lot of the peers in the semiconductor landscape. And I think you could find companies that are going to grow both revenues and earnings this year that are trading at or below historical sort of averages. And if you believe that AI is going to drive this margin expansion, then I think we can make an argument that we're going to see multiple expansion. So if all of that works, I think you've got upside in the semiconductor space, if this all works out. But you're right. I mean, there is some of that, kind of posturing going on, based on what investors think the Fed is going to do.
So there's more upside ahead. Outside of NVIDIA, who are the other top picks? AMD, probably one of them. Who else do you like, or who else do you think is best positioned?
So AMD, certainly. AMD, in our view, is a number two, distant number two, but they're going to participate this year at the important customers, so the cloud service providers. And if you look beyond that, I talked about NVIDIA and networking, right? So networking is this major area of investment, I think, coming up, because these AI networks are generating a ton of data, right? And a ton of data eventually has to move out to the edge of the network. And that's where we're all going to be using AI on our devices, on our phones, et cetera, in our cars. And as those networks are buffered, there's a lot of, sort of companies that investors might not think of that have been playing in historically, sort of these telecom networks that aren't really growing that much right now. But when you look at the cloud service providers, they're actually building huge networks like the telco service providers had historically. And so we like companies that participate in optical networking, for instance. Ciena is a company that we like a lot. Infinera is a small cap company that participates in that landscape. If you look one layer below, you've got component companies that actually make the lasers that are driving the data bits across fiber cables. And so companies like Lumentum would fit under that category. Coherent is another one we like. So there's I think a big bucket that we talked about in the note of companies that could benefit over time from AI.
All right, great conversation. Ruben Roy, Stifel's Applied Tech Analyst. Thanks for joining us.
Thanks for having me.
All right, coming up, we're getting technical, which only means it can be time for Jared Blickery. We're going to talk about the VIX and stocks moving in the same direction, what this normally leads to, and what does it mean for investors in the short term. Talking about all that coming up right after this.
If you can talk about one big theme for 2023, it has to be AI.
The AI hype cycle has swept the nation this year.
AI is still drawing a lot of attention.
The AI boom.
AI boom.
Increasingly powerful AI models.
AI.
Don't miss Yahoo Finance's coverage of CES 2024 in Las Vegas. We'll bring you the latest news, innovations, and big ideas in artificial intelligence.
All right, we are just about a half hour into trading here on Wall Street. Stocks edging lower to start the day. We see the Nasdaq lagging once again, down about 0.6%. The Dow, the relative outperformer, down 0.4% after that record close we saw to begin the year in the Dow. Though again, all the attention really on what's happening in the Nasdaq. And when you see markets going down, where do you naturally look? Of course, the VIX. And when we look at the VIX, who do we bring on? Yahoo Finance's Jared Blickery standing by to talk a little bit about what we've seen, Jared, with the VIX up almost a full point today. We saw the VIX, really down in the low teens most of the end of 2023. What are you looking at there as we see the market kind of rotating through to start the year and volatility maybe coming back into the picture a bit?
Yeah, a couple different themes. First, the big picture is that the VIX has been trading low. You can see it has a 13 handle right now. It's been low for some time going back to November. And this is just a multi-month chart, but you take a look at the last 3 years, and I'll put a line graph on here so you can really see how it has trended down and then it has stayed down. The other thing that's going on, as you mentioned, is that the VIX has been rallying in lockstep with the S&P 500 on certain days. That's not supposed to happen, although it does, because option theory, I'm not going to get into the wonky math of it. It just happens sometimes. But Andrew Thrasher over at Thrasher Analytics has taken a look at this, and he's looked for signals over the last 23 years. This goes back to late 1990s, when the VIX and SPY, that's the S&P 500 ETF, rally within 21 days. If they're up 10 of those 21 days together, that's a signal. And what it portends is potential VIX spikes. And so if the VIX goes further up, that historically has been concomitant with a downward draft in equities. So when you see these VIX spikes, this has been a short-term downtrend in stocks. But I should emphasize, this is not a long-term indicator. This is just kind of a short-term, things are out of whack, and let's see where this is going to go. But we got a spike in the VIX of 12 in about 2004. We got another one around 2011 here that was worth 6.5 points. In 2016, maybe early 2017, we got one for 26 points. You put it all together, and we could see a little bit of a downdraft given the Santa Claus melt-up rally that we've been seeing since late last year. I do want to point out that the VIX fear gauge, this is seasonality. This map, this is the average from 1990 to 2023. This worked very well last year, and I was overlaying this basically from the second half of the year. This has been calling the twists and turns of the market very well. So since we are back in January, I'm going to be looking for some potential downside VIX in February, but we could get this spike in the meantime. So that would be kind of par for the course for what I've been talking about here. So we may get a little bit of a VIX spike, but it doesn't necessarily signal that big trend change.
All right, Jared Blickery, thanks so much for breaking everything down here for the VIX and what investors need to keep your eye on here as we enter 2024. Well, we've got some breaking economic data on the other side of the break, the latest look at some jobs numbers. We'll be right back. Welcome back to Yahoo Finance Live. I'm Shauna Smith alongside Miles Udlin. We're about 30 minutes into the trading day. We're just getting some breaking news, some fresh data on the markets here to discuss. The fresh data on jobs, job openings, JOLTS job openings coming in at 8.79 million. That was lower than expected. The street was looking for 8.82 million. So maybe a bit of good news here as we're hoping to see the jobs, the labor market cool off just a bit. Of course, though, historically speaking, you need to put it into context because 8.79 million still well above the levels that we were seeing pre-pandemic. But this is the lowest number that we've seen for JOLTS here, Miles, since March of 2021.
Yeah, I was going to say, I remember writing about, 7-something million job openings, like what a great time to find a job. But I think, to your point, it really speaks to the continued trend across the labor market, across a lot of economic data, of numbers still being good on an absolute basis. But of course, it is the rate of change, and are we seeing a slowdown in some pockets of, again, either the labor market? We just had some manufacturing data from ISM Cross at the same time, also showing continued contraction in activity there. So overall, I think in line with the dominant theme of the U.S. economy, which is one that remains in fair standing, but showing some signs of a slowdown. Obviously for Powell and the Fed, I think this is exactly what they're looking to see. But anytime you get a since 2020, since 2021 kind of number, certainly something that people are going to be, paying attention to, something to take note of.
Yeah, certainly, and something that we were looking ahead to here in terms of what this could mean for the immediate reaction for equities. But then, of course, coming ahead of the big jobs number on Friday and exactly what that is going to tell us in terms of the jobs that were added to the U.S. economy in the month of December, whether or not we're going to see this deceleration that we had seen at the end of 2023 and whether or not that's going to continue here as we look ahead to 2024. So, of course, some weakness. But then on the flip side, markets don't want to see a labor market that's obviously falling off the cliff because then, of course, what that signals here for the U.S. economy.
Yeah, well, I don't think anything about the JOLTS number falling off a cliff.
Not
We're
at
on the
all.
cliff.
We're nowhere near it.
We're staying fine. We're staying fine. All right, joining us now to talk a little bit more about the state of the U.S. labor market off this JOLTS report and ahead of Friday's December jobs report, Stephen Ricciuto, Mizuho Securities USA chief economist, joins us now. Steve, thanks so much for hopping on. I want to talk a little bit about kind of how you see the labor market right now. We just got these JOLTS numbers, but obviously, a much bigger picture out there in terms of what we've seen in job gains. They continue, and how you are evaluating the state of play heading into 2024.
Yeah, well, I think that's a great question. I think the answer to that really revolves around what we're seeing in terms of the initial unemployment claims and the continuing claims data, which feed more directly into the payroll employment report than do the JOLTS numbers. And those two indicators are very, very important historically, and they are showing us that the labor market remains very, very tight. People that have gotten fired have gotten jobs very, very quickly to replace the ones they lost, and other people are coming in off the sidelines and getting new jobs as well, which is why the participation rate is going up. So I think the combination of those two events tell you this labor market is still hot, as the high level of openings, even though it is lower than expected, as the continued high level of job openings suggest.
And, Steve, ahead of the jobs report we're going to get on Friday, we'll get another round of claims data tomorrow morning. And we just had claims up on the screen. We've seen that number remain fairly stable, I think, to the surprise of some. How have you thought about those real-time indicators of the labor market? And perhaps, coming to your view, I think you had in your note to us that people remain just much too bearish on the outlook right now. What do you think some people are, I don't know, either they're getting wrong or they want to see in the data that's just not showing up?
People really, really want the Fed to cut interest rates. And the Federal Reserve, to some extent, has been leading the bad wagon on this, which is why you've had to see, since Jerome Powell's latest press conference, a number of Fed members come out and try to step back from this idea of March rate cuts. Because, the Fed really, really would love to reverse some of the policy tightenings, take out some insurance rate cuts. The problem is the economy isn't giving them that information, and that becomes the end result driving force in here, is whether or not the Fed will have that opportunity. So people have wanted to look into the data to find things that are constructive, rather than looking at the data from a broad-based perspective and saying, hey, we had an economy that grew at 5%. in the third quarter of last year. Okay, it grew 2% in the fourth quarter. You average that, that's 3.5% per quarter. That's a very healthy economy compared to an economy that has a trend rate of growth, according to the Congressional Budget Office, of 1.75%. It's almost twice the trend rate of growth. That's a healthy economy. And people want to ignore that, and they want to focus in on the 1.5 to 2% type growth areas and the belief that that's going to lead the Federal Reserve to cut rates.
So, Steve, then what do you think, I guess, is a more realistic timeline for the Fed then to cut rates? And in order for them to do so, what do you think they need to see that's going to make them feel comfortable cutting rates?
Well, they're going to need to see inflation a heck of a lot closer to 2%. In addition to that, they're going to need an unemployment rate that is a lot closer to the natural rate of unemployment, which is 4.5%. And, we're well below that at this particular juncture. We're at the 3.7, 3.8 level. So the reality is there's a big, big gap between how tight this current labor market is and what a normal labor market should look like. And I think we're seeing that the labor market has not really freed up as the Fed would hope, as job openings have come down. There is some little downward dampening pressure on wage gains, but let's be honest, we're now at the point of 4% wage gains, which is, again, well above the level of wage gains you would expect if you were going to have a sustained 2% inflation rate.
And Steve, I know we're a couple weeks out from the data, but inflation has really kind of taken center stage away from the labor market to some extent in terms of the driver for the Fed. I'm curious, one, what you made of that PCE data, 6-month and average annualized core PCE under 2%. Everyone very excited about that. How you're thinking about the inflation picture as we head into next year, and is perhaps this an area where people think there's too much momentum to the downside, where maybe things are going to be stickier?
Well, you have to understand, all of the decline in the inflation has been concentrated in the goods component. And the goods component is heavily correlated to the exchange value of the dollar. And the dollar has been in a very, very expensive position in the last 2 years, as the Fed was in the position of raising interest rates. We peaked out in the 113 area. We then dropped to the 107 area on DXY, which is an average index for the dollar. And now we're broaching the 102 area, and we've tested the 101 area. You get back to 100 on these dollar-weighted averages, and you begin to see that the currency is no longer going to be able to provide the downward bias to goods inflation that we've been having. And considering where service inflation is, it tells you it's going to be harder to get back to that 2% type inflation rate. And to some extent, I think the Fed is willing to accept a higher inflation rate in the longer term, because they'd like to not have to flirt with the zero interest rate barrier again. But by the same token, the market hasn't taken that on board, and the long end of the curve is expensive relative to a 2% inflation target, let alone an inflation rate target above 2%.
Yeah, so Steve, so what do you think that rate could potentially look like that you think the Fed is willing then to accept maybe in the longer term?
Well, I think there's enough rhetoric from the Fed to suggest that they wouldn't mind seeing inflation closer to 3% than 2%. I don't think they have a specific target in mind. They're going to be reviewing policy in the next year and deciding what they're going to do with it. But they did move away from an inflation target to an average inflation target, where they're willing to live with upside deviation in inflation from 2%, as long as the market believes they will get back to 2%. But they really are not willing to tolerate any downward deviations in employment. But when they're dealing with such a tight labor market, they have to look for the labor market to come back to more realistic levels if they're going to be able to have a 2% sustained inflation rate. So I think the answer is eventually they will settle on something closer to 3% than 2%. They haven't done it yet, but I think in their minds, they're all thinking that way.
All right, Steve Risciuto, always great to get your insight. Thanks so much for joining us here this morning. Mizuho Securities Chief Economist. Thanks. Well, riding to the upside, Wells Fargo calling out Uber as their top pick in the mobility space. We're going to chat with the analyst behind that call next. Good morning, Wall Street. Straight from Yahoo Finance's front page to your mobile phones and to your streaming apps. Watch our new flagship show, The Morning Brief, your first stop as we guide you through the day's market action.
We give you insights into the latest market-moving news, real-time analysis of today's top stories,
And actionable information about your investments.
We bring you the opening bell on Wall Street. And don't miss our strategy sessions with Wall Street's top analysts.
It's the Morning Brief.
It's the Morning Brief.
The Morning Brief.
Yahoo Finance's Morning Brief, empowering you to make smart investing decisions. Tune in daily at 9 a.m. Eastern.
All right, well, Uber stock cruised in 2023, closing out the year up over 140%. Analysts over at Wells Fargo see more potential for the ride-hailing stock in 2024. The investment bank calling Uber a top mobility stock pick for this year. And joining us now to talk more about this bullish call, Ken Gorelski, senior analyst over at Wells Fargo. So Ken, I want to start with kind of the story for Uber right now and the one that got the street excited last year in your view. Like, what were the levers the company pulled in 2023 and where you see them, kind of pulling things as we get into this year and beyond?
Absolutely. Thanks so much for having me on. So the story in 23, where you're right, there was exceptional performance, outperformance of the Nasdaq and the market overall for Uber was, I think, a continued healthy overall rides and delivery fundamental case and growth, combined with margin leverage, right? And this has been elusive for the company for many years, but they are delivering on what they've promised. And so I think the combination of the two, and frankly, as we kind of move to the next, and this is as we talk about 24, as we move to that, this is the next iteration of what Uber is evolving to. Was if you go back, this was a summer 19 IPO in the low 40s. The stock's now at 58, right? So the stocks hasn't moved a whole lot over those many years, but we went through a COVID period that was a complete reset. But we think this is going to be a very much a simplified compounder story. It's hard to find large cap compounders in this market. And we see this as a $125 billion market cap that can compound nicely with some incremental drivers in the first half of 24.
And Ken, thinking about Uber and Lyft, and we'll keep it just to the U.S. ride-sharing market, I'm curious what the state of that story is. Obviously, both companies now have other components to their business, but you mentioned the 2019 IPO. What got us there was that market, coming into existence, 14, 15, 16. Right. What's the state of play today in the U.S. ride-sharing market between those two companies?
So we're roughly 70-30 market share, a couple points here or there. Uber with the leadership share, Lyft at the number 2 spot. I would call this a pretty rational duopoly, and they fiercely compete for riders and for drivers, but this is evolving into a more rational duopoly. We have a new management team, a new executive team at Lyft. I think these companies are less share focused and more focused on generating value for all stakeholders. That includes drivers, riders, and shareholders. And I think so. I think we are kind of in that next step of evolution into a duopoly market domestically. And we've seen healthy supply of drivers, which helps the marketplace. We've also seen healthy demand, and we think that continues into 24.
So Ken, here we are today, like you said, 70-30, that new leadership at Lyft, their ability, I guess, how confident are you that they are going to be able to chip away some of that market share from Uber? What does that timeline look like?
Sure, it's a great question. So I think the new management team, they've stressed that they're going to do it via product innovation and not via pricing. So if you look in the past, there's been prior Lyft management had taken some pricing initiatives and they subsequently lost share, right? And so what I think you will start to see is more product differentiation. There's a product at Lyft called Wait and Save, which appeals to more value conscious customer. Uber tends to skew a little bit higher on the demographic scale. But we see overall pretty healthy competition. I think at the margin we'll see a couple points of share trade hands, but overall we see a pretty rational environment here.
And Ken, the last name really within this universe is DoorDash, and I'm curious what you see there for their business, the things that they're kind of looking at as they head into 2024, and really the ways that they are or are not competing with Uber on some of those crossover markets. For the time being, we'll leave the Instacart IPO discussion out of this, but just curious on the DoorDash question, kind of where you see that company headed. Again, we see here equal weighted on that stock heading into 2024.
Yeah. So DoorDash was another very impressive performing stock in 2023, and it was really about positive revisions. So what I'm saying is that the street, the consensus EBITDA estimates moved up significantly for 2023 and 2024. We actually see continued upward movement in those numbers into 24. Now, DoorDash operates in the core food delivery business, is also expanded into grocery and convenience areas where our newer investment areas, they're losing some money in those areas. But what we've seen is that DoorDash has a leadership position in food delivery domestically, but again, we are seeing a rationalization of competition. If you go back several years ago, there was a period where there was intense competition, intense promotions on the consumer side, and there was many venture dollars spent and kind of lost in this area. Now we've seen a rationalization of these markets, and we see a healthier overall backdrop heading into 24.
All right, Ken Gorelski, great to have your insight there. Wells Fargo senior analyst. Thanks so much.
Thank you so much.
Well, we are watching shares of two oil giants here this morning after a call out from Mizuho. Now, the firm naming Chevron a top oil pick. They also downgraded Exxon and Occidental Petroleum. Yahoo Finance's Ines Ferre is at the big board here with the latest on that. Ines.
Yeah, Shauna, and Mizuho analysts have downgraded 8 stocks altogether, upgraded 3. Their thesis is that macro headwinds are likely to leave oil and natural gas prices trading in relatively tight ranges or sideways. And looking into 2024, analyst Nitin Kumar is saying investors should focus on stocks that can create their own catalyst, either through their asset base or through extraordinarily low balance sheet leverage. Among the stocks mentioned, you just mentioned it, Chevron kept as a buy. ExxonMobil and Occidental Petroleum downgraded to neutral. Now, these are some important stocks because we talked about these last year as all 3 companies have actually recently announced acquisitions. As far as ExxonMobil, downgrading it to a neutral with a price target of $117, down from $133, but that's still an upside of 16% from its current value right now. And then as far as Occidental Petroleum is concerned, that price target was lower to 63 from 72 with, again, a neutral rating. Now, the analyst is citing valuations here, risk to cash returns that they are making these stocks a little bit less defensive. What's been interesting, though, is through this note is talking about this thesis about where oil prices are heading into 2024 and some nebulous scenario there because you have the OPEC plus cuts that have been announced, but you also have more production from the U.S. So this analyst, along with other analysts that I've also spoken with, seeing that oil prices are going to be kind of trading sideways going into this year. And we'll see how this pans out throughout the rest of the year. But even JP Morgan's note last year in December saying that you're going to see a little bit more of the same when it comes to oil prices. And much of the reason why this analyst, Mizuho, downgrading a couple of these stocks and upgrading our top pick for one of them, guys.
Yeah, and as it seems like everybody can make peace with oil, let's call it 65 to 85. You go on either side of that band, then you seem to have a couple of problems with your model there. All right, Yahoo Finance's Ines Ferre. All right, all your markets action ahead. Stay tuned here on Yahoo Finance Live.
We're here in Las Vegas, Nevada, outside of the Sphere. It's the massive music and entertainment venue that opened a few months ago. But the real reason we're in Sin City is for CES 2024. It's one of the largest tech shows on Earth, and we're going to be bringing you all of the news, innovations, and ideas out of...
Hey, Howdy, hold on. We're not in Vegas, man. We're still in New York. And that's not the Sphere. It's a cube.
I'm gonna miss my flight. Oh, taxi! Don't miss Yahoo Finance's coverage of CES 2024 in Las Vegas.
70 years, the Corvette has been known as America's sports car. The mid-engine, the long hood sports car was what every red-blooded American dreamed of owning. Heck, even Joan Didion loved the Corvette. The Corvette is dipping its toes into the future with the electrified E-Ray. We're here in Bowling Green, Kentucky, where the Corvette is made and the first ever E-Ray is rolling off the production line. Let's go in and check it out. Corvette here has been built since 1981, starting with the C4 in earnest and then all continuing on through the C8 and even the E-Ray. At this stage of the process, the cars have been married in the back just down the line, where basically the chassis has met the undercarriage, which contains the drivetrain, the powertrain, and also the battery gets installed back there for the E-Ray. These cars are almost complete. They need some finishing work done, need some wheels, and they need to go through inspections, and then sort of the safety tests and things like that, and then they're out for delivery for their customers. Let's get more on the E-Ray and the start of production here in Bowling Green with the man in charge, GM's General Assembly Future Product Lead, Andrew Keltner, who's standing behind the first ever E-Ray off the line, VIN number 1.
Corvette's good at rear-wheel drive. We've always done it. All of our tooling in the plant set up so that way all your driveline components, everything assembled to perfection in the rear. So we've had to actually shift our manufacturing process to now cover both the front and rear, right? You got driveline in the front with the electric motor, separately from the driveline in the rear with that V8 engine. So really a challenge for us setting that up. The dream of the C8 always included the E-Ray in some form or fashion. So the package space that the product engineers provided, it was there. Just like with the product engineering being available, we tuned our manufacturing space to better position us in the future. So we created holes in the assembly line for our tools to load that 300-volt battery up into the car. So a lot of things we took into consideration with the C8, knowing the future was coming with that all-wheel drive electric.
And here it is, the E-Ray, the first ever Corvette with front-wheel drive powered by an electric motor. Now this motor paired with the V8 in the back gives this car over 650 horsepower, making it the quickest Vette yet, capable of a 0 to 60 time of 2.5 seconds. The E-Ray's all-wheel drive system means this is a Corvette for all seasons, including winter. Engineers tested the car in the mountains of Colorado with the E-Ray powering through. The 1.9 kilowatt-hour battery in the E-Ray is small, but it does have the ability to discharge a lot of energy and recharge itself fairly quickly, more so than normal hybrids. The battery is also capable of giving the car around 3 to 4 miles of range, which doesn't sound like much, but it is helpful in cities where emissions are banned. All right, behind the wheel of the E-Ray, the Corvette E-Ray hybrid. And let me tell you, I have driven a regular Corvette C8 before. The first impression of this car is that it just feels like it's driving on rails with that, because of that motor in the front, giving this car all-wheel drive. It just seems like there's an immediacy to turn in. It feels like the car is on rails. It has a, the car has the ability with software to give you the best traction with the all-wheel drive system because of the fact that it's got a motor in the front, electric motor, and it's got a gas-powered, the V8, 6.2 liter in the back. That's just giving you all that rocket power. I'm in sports mode here, sport mode here. Immediately, 2.5 second 0 to 60 time. That is no joke. That is no joke. I mean, listen to that. It is just unreal. For many fans, the history of the car is what appeals to them. So to really understand the Corvette story and where the E-Ray is taking America's sports car, we need to see where it all started 70 years ago at the National Corvette Museum.
It was revealed in GM's Motorama, a big car show with a lot of concept vehicles in January of 1953 as the Corvette. And it caused a sensation when it was initially revealed. Had all the looks and styling of a sports car. And one of the folks who was in the crowd at Motorama for the Corvette's reveal was Zora Arkus-Duntov, who was a racer turned engineer who went to work for GM shortly after the Corvette's reveal. and he was the one who really turned it into a performance car. He led the way in convincing GM to make this a car that appealed to not just people who wanted to cruise the boulevard, but also race it. I think the reason that people really, love this car and want to drive this car is because it represents what we love about driving. The speed and the performance. Our big thing here at the museum is to tell the story about Corvette's history, educate people on the evolution of the car, and we're really happy to see that evolution continuing with electrification and bringing on that next chapter of Corvette's history.
But the Corvette E-Ray isn't the only hybrid sports car on the road. There are cars in the space that operate in the hybrid supercar space. The McLaren Artura is one. The Ferrari 296. I mean, that car is just a world beater, that 296. Those cars are great, but they're actually, I would say, almost twice as much money as this car. So you have to ask yourself, is there true competition? This car starts at about $105,000, and this trim about $115,000. The only car that comes somewhat close is the Acura NSX hybrid, and that car is also a mild hybrid, meaning you don't have to plug it in. That car got discontinued. Acura discontinued that car. It's not going to happen. On the track, on the road, and even snowy mountain passes, the Corvette with the E-Ray is now a car for all seasons. And with electrification now upon us, who knows what the next 70 years of Corvette will have in store? Yeah, I think a lot of Corvette fans would consider electrification a dirty word, but at least with my drive with that car, it just seemed unbelievable in terms of the power that it produced, and then sort of with the front-wheel drive electric motors, you can just turn. It's just unbelievable on rails for me.
So, Praj, do you think that it sounds like you think this is going to be a huge hit? I would guess just among Corvette lovers in terms of. I think the fact that maybe initially, like you said, when people think of a car like Corvette, they wouldn't initially think that people would be right off the bat embracing the fact that it is electrified, or it's a hybrid, at least at this point. That doesn't seem to be a roadblock at all, at least in your view, right?
No, because they're still going to have the base Corvette, they'll have the Z06 high-end performance one, and then in that middle they have the hybrid where it's like, hey, I live in Michigan or Illinois or Pennsylvania, and I want a car that I can drive in the winter, and that car comes in all-season tires. So it's just a Corvette for all seasons. It's a different performance kind of equation for that car, and I think that it's just the future of this 70-year-old car, right? I mean,
you looked good driving it too. It looked like it rode pretty smoothly.
I know. If I had the money, maybe that'd be mine. But
all right, Prez, let's talk about another story here that we're watching, because Ford recalling over 100,000 F-150 trucks in the U.S. The latest recall here for the company. What can you tell us about this and how big of a challenge maybe this is for Ford at this point?
Yeah, just saw this cross here: 112,000, 113,000 F-150s with it's a rear axle hub that might break. In some situations, it's with cars that have the trailer tow max duty package. So what they're saying is that this hub bolt might fatigue and break, and when the car's in park, it might roll away, and you might have loss of power, and also just it'll roll away for an accident. Big picture is another black eye for Ford. The company's been mired with so many reliability and recall issues. Last year, they had 870,000 pickups recalled for an electronic parking brake issue, and then last year, Ford is the #1 most recalled brand among all major automakers. So that's just not good for Ford, and it just adds up to the costs of warranty and recalls and fixes.
How big of a headwind has that been up until this point, just in terms of reliability and maybe people second guessing or thinking twice before they purchase a Ford vehicle?
I mean, Jim Farley's brought this up like almost on every call in the last year because of the fact that he said we have to fix these reliability issues. This is a sort of a remnant of years in the past. It's a black eye for them because this is their #1. This is their icon, like the F-150. If it's known as unreliable, I mean, that gives an opening for Silverado, for Ram, and things like that.
Yeah, Jim Farley has been very vocal about that here over the last couple of quarters. All right, Pras, thanks so much. Well, U.S. debt topping over $34 trillion for the first time ever. This coming as a deadline looms for Congress to reach a deal in order to avert a government shutdown. Yahoo Finance reporter Rick Newman is here. And Rick, when you take into account the skyrocketing national debt that we have, pretty disappointing, concerning here at this point, yet voters don't seem to care.
Well, voters care in theory. Polls say that if you ask voters, is the national debt too high? Yes, it's too high. And just qualitatively, I mean, they sure complain about it when they write to me if I'm doing something on a related topic. But what voters don't want is the painful choices that would come with the solution. I mean, getting out of this problem means you either have to raise taxes or cut spending, and not cut spending by trivial numbers such as cancel some art spending or something like that. You have to take on the big programs where the money is, and that is Social Security, Medicare, Medicaid, and defense. And so if you say to just about any voter, how do you feel about cutting Social Security? No way, don't do that. What about cutting Medicare for seniors or health care for poor people? Nah, we don't think that's a great idea either. What about raising taxes? Well, fine if you raise somebody else's taxes, just don't raise my taxes. And, the ability of the United States to borrow seemingly endlessly has gotten us into this problem. So it's no surprise at all we hit $34 trillion. We're going to hit $35 trillion probably later this year. And by the time the next president is out of office, we're going to hit $40 trillion in national debt.
So, Rick, given all this and given the fact that we do have a deadline coming up here in less than 2 weeks at this point, that the government could potentially shut down if a deal is not reached on future funding, on future spending, what's your best guess, I guess, at this point, just in terms of where talks stand and how likely we are to get some sort of deal before that first deadline?
We don't really seem any closer than we have been. Going back to when Republicans fired Kevin McCarthy as their speaker. Kevin McCarthy has now left Congress. He's not even around on Capitol Hill anymore. And there's no evidence that we've gotten any closer toward any kind of deal. So, I mean, Republicans are basically demanding these fairly sharp spending cuts that Democrats who control the Senate are unlikely to agree with. So, I mean, in normal times, there would just be a compromise. The House Republicans would get some of the cuts they want, and they would not get other things they want. And the Democrats who control the Senate would get some of the things they want, such as more funding for Ukraine, for the war there, where that funding has run out. It's just an open question with basically in the House, you have a fairly small number of the most extreme conservative Republicans who seem to have control of the party. And this new speaker, Mike Johnson, comes from that wing of the party. So it's going to be quite interesting to see how this all plays out. I mean, I don't think there's really a template for this. I mean, a lot of times we know how Congress comes together and make a deal, but not when an extreme faction of one party seems to control the whole party. So I'm very interested to see how Republicans get out of this cul-de-sac.
Yeah, of course. And then, Rick, there's also the slight issue that Congress is only going to be in session for just over a week before this deadline, too. So the fact that they're so far apart, the fact that there is so much disagreement within the Republican Party in the House doesn't make it too likely. But we'll see. Maybe we'll be pleasantly surprised. Rick Newman, thanks so much.
See ya.
All right, keep right here on Yahoo Finance. We've got much more of your market action ahead. We'll be right back. Good morning, Wall Street. Straight from Yahoo Finance's front page to your mobile phones and to your streaming apps. Watch our new flagship show, The Morning Brief, your first stop as we guide you through the day's market action.
We give you insights into the latest market-moving news, real-time analysis of today's top stories,
and actionable information about your investments.
We bring you the opening bell on Wall Street. And don't miss our strategy sessions with Wall Street's top analysts.
It's The Morning Brief.
It's The Morning Brief.
The Morning Brief.
Yahoo Finance's Morning Brief, empowering you to make smart investing decisions. Tune in daily at 9 a.m. Eastern.
Wells Fargo out with a more bullish call here on Citigroup. Analyst Mike Mayo saying that the stock could more than double to over $100 per share over the next 3 years. We want to bring him in now. Joining us here on set, Mike Mayo, Wells Fargo's managing director. Mike, it's great to have you here in studios. Let's talk about that bullish call here for Citi. In terms of the catalyst, a number of changes have been made here under CEO Jane Fraser. What makes you so positive about Citi's story at this point?
Well, we did come out with a 50-page signature research report. And so we put a lot of work into this. And as you know, I've covered the company for about 3 decades. And I think this is the CEO, Jane Fraser's moment of truth. 3 years from now, she could potentially be Banker of the Year, or she could potentially be out of a job. So the range of outcomes for the CEO is quite wide. I will say I think Citigroup is kind of ripping the guts out of the inside, restructuring it in a way they haven't done in modern history. They have org simplification where they're reducing management layers from 13 down to 8. They have a transformation where they're modernizing the back office, and they have a range of business exits, especially non-US consumer banking, which has been a fail for the last half century. So the upshot of this is, we think, significantly improving efficiency, returns, and stock price over the next 3 years. As we see a double in the stock. Not without risk. If there's a recession, then it could be a lot of downside for Citi, but absent a recession, our range of scenarios shows a very nice reward to risk ratio.
So given that setup that you see for Citigroup going into 2024 and beyond, in terms of the comparison that you're seeing for Citigroup stacking up against JP Morgan, I know you've been a fan of JP Morgan now for quite some time. How do those two stack up just in terms of the leadership that we're seeing among the large banks?
Well, JP Morgan's best in class and Citigroup is worst in class. So JP Morgan was our top pick last year, especially after the failures from regional banks, and that performed well. And now I'm thinking, okay, how do I add alpha for investors in 2024? And I think that's the worst in class company, which is Citigroup. They have worst in class efficiency, returns, and stock price valuation. But I think incremental change can make a huge difference. And so I think there'll be additional visibility. For the first time, Citigroup will just have 5 lines of business.
Yeah.
Forget about Latin America or Asia or Europe or Middle East and all this matrix management. 5 lines of business. So we're talking about services, banking, and markets. That's 60%, rough. That's wholesale. And then you have personal banking and wealth. That's the other 40%. That's what I would call consumer. And that's how they're going to manage the company. And by doing so, they rip out some intermediate lines of business. They dismantle legacy infrastructure that goes back decades, so they should have big cost savings. Having said that, if you've owned Citigroup stock the last 2 years and you still own it, you're really angry. And I've spoken to some very angry investors who are saying, enough Citigroup management, we need to see results. You blew up the profit and loss statement by having expenses that have gone out of control. And expenses are up over $10 billion the last 3 or 4 years. So it is an outlier in terms of terrible performance. Now, you give them some credit because they're addressing problems that were ignored for 2 decades. So, our forecast shows that some of these expenses will start declining and they'll start to get the benefits of these investments. And the question is the timing and the magnitude in investors' minds. So there's definitely a debate going on here, but I'm taking the positive side of that debate, especially with the stock down in the low 50s.
Yeah. And we just had the 2-year chart up there on the screen. The shares off just about 16% over the last 2 years. Mike, you mentioned one of the risks here, not just for Citi, you could say for every bank, or a number of companies out there, the risk of recession. If we do see the Fed cut rates, that setup that then will provide here for names like Citi, for some of those larger banks, how do you see them performing if in fact the market is right and we do see a more aggressive rate cuts from the Fed next year?
A lot of investors have been waiting for the Fed to cut rates to jump in and buy banks on the view that banks are cyclical. And if the Fed's cutting rates, that will be better for the economy than it otherwise would be. And I think you saw with the Fed's pivot in December, bank stocks started to outperform. But when you actually see it happening, I think banks will perform even more. And I think the risk of the downside will be mitigated. Having said that, put in context Citigroup was the poster child for the mistakes of the global financial crisis. As you know, I I was the first to testify to the Congressional Committee on the causes of it, and Citigroup was front and center. I have my book, Exile on Wall Street. 2 of the 10 chapters are about the shortfalls of Citigroup for the last century. They basically failed for 5 times the last century. Having said that, for the last decade, Citi has de-risked about as much as any bank. So in terms of their corporate credits, I mean, we're talking about 85% over investment grade. As far as their non-U.S. lending, a lot of that's to like multinational firms. On the consumer side, this is not a subprime company or anything like that. So they've de-risked when it comes to their loan portfolio, when it comes to their trading books, when it comes to their oversight and the stress test. So this is not the same Citigroup whenever we have the next recession. Having said that, our 50-page report is critical of the board because many of the board members were there when Citi missed its prior targets. So I think a board refresh could further facilitate Citi's transformation.
Mike, when we talk about some of the other risks that are out there here, just in terms of upcoming regulations, how likely are they just in terms of the strict regulations that have been proposed? Do you think something like that is going to get implemented, or maybe will it be a bit softer than what's being discussed right now?
Well, that's one of the concerns about Citigroup is like, who wants to own Citigroup with all the regulatory costs? And they have a special regulatory consent order that's unique to them. But even with that consent order, we have their efficiency improving quite a lot the next 3 years. And then you have the new Basel III, as it's known, regulation. I do think it won't be as harsh as expected. But even with that harsh, and Citi's one of the worst in class in terms of the impact of Basel III. Even with that, we have them buying back 1/5 of their shares the next 3 years. So even with those headwinds, Citi should still excel and improve, and I think that's underappreciated.
All right, Mike Mayo, always great to have you, especially here in studio. Thanks so much for making the time to join us here.
And a beautiful new studio that you have.
Thank you. Yes, your first time here on set. You got to come back again very soon. Thanks so much, Mike.
Thank you.
All right, keep it right here on Yahoo Finance. Much more of your market action ahead. Again, we are looking at red across the screen. All 3 of the major averages lower here on the second trading day of 2024. We'll be right back.
If you can talk about one big theme for 2023, it has to be AI.
The AI hype cycle has swept the nation this year.
AI is still drawing a lot of attention.
The AI boom.
AI boom.
Increasingly powerful AI models.
AI.
Don't miss Yahoo Finance's coverage of CES 2024 in Las Vegas. We'll bring you the latest news, innovations, and big ideas in artificial intelligence.
Let's do a quick check of the markets here. 90 minutes into the trading day, you're still looking at red across the board. The Nasdaq off another 0.9% following yesterday's sell-off, one of the worst starts that we have seen to a new year in quite some time. The Nasdaq off about 0.7%. You had the Dow off nearly 300 points. Well, coming up next hour, Michelle Akufo is going to be speaking with the co-founder of Pollen Returns about the state of the consumer and the trends that they're seeing right now within the retail sector. And you're also going to want to stick around for our interview with U.S. Secretary of Transportation Pete Buttigieg. He's joining Yahoo Finance in the next hour. We'll be right back.
Welcome to Yahoo Finance Live. It's 11 a.m. on the East Coast, 8 a.m. on the West. I'm Michelle Akufo. Here's a look at what I'm watching this morning. Tech seeing a painful start to the year, dragged down by an Apple downgrade from Barclays. But does the street think the trend is here to stay? And with analysts warning about iPhone demand, could Apple's VR headset be the bright spot in 2024? Plus, what could a potential government shutdown mean for transportation? We'll speak with the U.S. Secretary of Transportation Pete Buttigieg coming up this hour. First, let's take a look at how the markets are faring an hour and a half into the trading day. Looking at the Dow, they're solidly in the red. They're down about 240 points. The S&P 500, they're also down 0.6% or about 30 points on the day. We saw that jobs data. We saw job turnover, some softness in November's jobs data. Looking at 1.4 job openings for every unemployed person versus 1.8 according to the BLS. Also taking a look at the Nasdaq as well, seeing that off by about 100 points there. Sector-wise, energy, of course, leading the charge. Real estate and materials under the most pressure. They're looking at the tech sector. We're seeing Apple and Tesla really weighing on the Nasdaq as well. Let's also check in on the Treasury market as well. Look at the short-term yields there, up about 1.2% on the day. The 10-year, as you can see, solidly at 4, currently up about 1.33% so far this morning. And the longest-term 30-year yield currently sitting at 4.14. Well, global stocks had their terrible, horrible, no good, very bad day. Investors were greeted with one of the worst opening days for global stocks and bonds in decades. And it looks like the downward trend is continuing. I have Yahoo Finance's Jared Blickery here to break down those moves. Jared, it was all good just a week ago. What happened?
It was all good 24 hours ago. Things kind of deteriorated in the afternoon a little bit. But suffice to say, as you said, this is the worst start in quite some time when you look at both stocks and bonds. In purple, and by the way, this goes back 20 years to 2003. In purple, we have the first day of the year TLT returns. That's a bond proxy. And in cyan here, we have the first day stock returns. That's a proxy too. Both were negative yesterday. It hasn't happened since TLT was basically invented. It came to market in 2002, although we do have a proxy that triggered this back in '99 based on global metrics. But what I want to focus on is the yield curve. This is the U.S. Treasury yield curve as of October 19th in purple. And then way down here is January 3rd. That's today. And you can see a lot of these tenors, especially in the belly here, around 10, 20, 15 years, that has dropped by about 100 basis points. And that is just a huge move. That's been a huge tailwind for not only equities, but also mega caps. We saw the rally really expand last year to include, beyond Apple and Amazon and those others, a lot of the value sectors that have been left behind for the year. Want to show another chart here. This just shows you how much the bond market has rallied over the last 2 months. This is this rolling 2 months returns here. This goes all the way back to 1990. This spike that we just printed here as of the end of last year, we haven't seen anything comparable to it until you have to go back all the way to 2009, the aftermath of the global financial crisis. So really interesting to see that such an extreme move there. And then when you add it to stocks, you have the 60-40 portfolio. That is back to 12.16% over the last 2 months. Versus 14.25%. That was April of 2009. That was the very beginning of QE1 and that bull market back there. So something's underfoot in the market. I don't want to say it's too bearish or bullish, but there are some inklings that we are a little bit defensive right now. Let me show you, we are 7 days. This is, by the way, the 7th day of the Santa Claus rally, the second trading day of the year. 7 days ago, we began the Santa Claus rally. Since then, the leading sectors are healthcare, utilities, staples, and then energy, some others in the green, but for the most part, that is very defensive. So that's my yellow flashing warning sign for the new year. You couple it with the Nasdaq, maybe this was a one-off and we just had to, or a two-off, including today's gains. Maybe we just had to come back out after a really meteoric rise late last year. On the other hand, could be the beginning of something else that's underfoot here. So hard to say.
Indeed. We wonder how much of that enthusiasm was already priced in at the end of the year.
Exactly.
As we're now looking at this interesting start to the year. Jared, as always, thank you so much. So how dovish is the Fed really? Now that's the question on many investors' minds as the FOMC's minutes from its December meeting are set to be released at 2 p.m. Eastern today. Now we heard from Richmond Fed President Thomas Barkin this morning saying that while a soft landing is, quote, increasingly conceivable, the potential for additional rate hikes is still on the table. Now, with the bond market currently pricing in more than 150 basis points of rate cuts by year end, could a more hawkish tone from the Fed lead to more bond market mayhem? We'll see Treasury yields currently, as you can see, all in the green solidly, peaking more towards that 4% mark that we saw towards the end of last year. And looking at the 30-year, currently sitting at 4.14. Well, joining me now on this is Colin Martin, Schwab Center for Financial Research's fixed income strategist. Thank you for joining me this morning. So, Colin, lay the ground here for us. What sort of road are we looking at versus the end of 2023, as we're still sort of waiting to see what the Fed is actually going to say and how hawkish of a tone it might take?
Well, we think if we look if it's going to be hawkish or dovish, it's probably going to be somewhere in the middle. And if we look back, just 3 weeks or so from the December FOMC meeting, the markets interpreted that as very dovish. Powell discussed the potential for rate cuts. The updated projections suggested that there will be easing next year. But if you look at what the markets are expecting versus what the Fed's projections tell us, there's still this wide gap. I think the minutes might show something more in between, a more balanced approach. I think there's a difference between the idea of talking about what criteria needs to be met to consider cutting rates versus an actual discussion to cut rates. So we don't think they've had the discussion to cut rates just yet, but it's very logical to assume that they're discussing what they need to see over the next few months before that becomes front and center at their meeting. So it'll probably be somewhere in between. They've told us that there's a risk to both over tightening and under tightening. And I think they'll highlight that there still is the risk that if inflationary pressures are bubbling under the surface, and if the labor market doesn't cool as much as some might be expecting, then maybe those rate cuts don't come as soon as the markets are expecting. Maybe we don't get as many cuts as the markets are expecting either.
So Colin, for some investors who were scratching their heads when they were looking at what was happening with bonds and how equities were rallying at the end of the year, but they're now looking at this first week here, we're looking at the VIX above 14, expecting this volatility. What changed, do you think, and what does that mean in terms of the potential for a rocky road ahead for bonds?
Well, if we look at what changed with the bond market specifically, if we go back to the middle of October when the 10-year Treasury yield hit 5%, only to then drop by 100 basis points in the matter of 2 months or so, that was a really, really large decline. And if we fast forward to where we are today, we've seen a little bit of a reversal of that. I think that's just natural, where bond yields likely fell a little bit too much too fast. And as you alluded to, Rochelle, with the rocky road, we expect Treasury yields to be volatile this year as there's this gap between those Fed projections and market expectations. If we look at what our fair value is for bond markets, specifically say the 10-year Treasury yield, we think it's around 4%. And that outlook is based on the premise that the Fed does cut rates a handful of times this year, likely just 3. That pulls short-term yields a little bit lower, steepens the yield curve, because an inverted yield curve is not the normal environment. It's not the normal slope of the Treasury curve. So we think long-term yields can kind of hover where they are right now, likely with a lot of volatility, and then we'll see short-term yields fall to sort of catch up and then re-steepen that curve.
So Colin, for people who are trying to figure out how to play the fixed income market, if they're looking at corporate bonds versus government bonds, what is your breakdown of the expectations? Where do you see the opportunities?
Well, we see opportunities in a number of different types of bonds out there. If we look at the big picture outlook for most fixed income investments that a lot of individual investors are considering, we think positive total returns seem likely this year because we do think the peak in yields is behind us. So we don't expect a sharp increase in yields, which will pull prices lower. But there are a lot of different types of bonds out there. And our main focus for investors, especially our Schwab clients, are to focus on higher quality investments. Because if you look at high quality investments, those with high ratings, specifically investment grade credit ratings, we're still at yields that are near their highs of the past 14 or 15 years. Yes, they're off their peak, but they're still relatively high compared to where we were for most of the years following the financial crisis. And if you look at the extra yield that riskier bond investments offer, like high yield bonds or preferred securities, that spread is relatively low. And we think it makes sense to take additional risk with riskier investments if you're being compensated for it. And that's really not the case this year. So if you look at those riskier types of bond investments, we also think positive total returns are possible and likely this year, but we think excess returns or outperformance relative to treasuries will be really difficult to achieve, mainly because of those rich valuations.
And as we were just talking about with Jared, a lot of defensive stances being taken to kick off the year. How do you balance sort of fixed income with the rest of a portfolio right now?
Well, we think fixed income, specifically high quality investments that we just discussed, those are really meant to provide ballast to your portfolio. Not that we can ignore what's happened over the past few years, but 2022 really was an anomaly. And if you go back over the past 30 or 40 years and what high quality fixed income investments provide, specifically those investments that make up the US aggregate index, negative total returns are relatively rare, and they tend to provide stability. So I think if you're an investor right now, figuring out how to balance your portfolio and specifically where to go in the bond markets, take advantage of those high yields that are available right now. And don't be afraid about going out a little bit further in maturities. We know it's a tough proposition to consider with short-term rates higher than long-term rates. If you look at short-term CDs or treasury bills or money market funds, those yields are admittedly very attractive, especially when you have a 10-year treasury yield at 4%. But those short-term yields aren't likely to be that high forever. So we suggest investors move a little bit further out and lock in that 4 or 4.25% for a number of years, rather than having to worry about what the Fed may or may not do between now and then, and just accept that 4% annually for a number of years, and you can kind of sleep well at night.
Indeed, certainly people trying to time the market, not having a good time with it at the moment. So certainly makes more sense to take that longer term view. Appreciate you joining me this morning. Colin Martin, Schwab Center for Financial Research's Fixed Income Strategist. Thank you so much.
Thanks for having me.
All right, I'm watching shares of wellness franchise group Exponential Fitness buckling under the weight of a downgrade from Piper Sandler this morning. The analyst Peter Keith taking the stock down to neutral from overweight and cutting the price target to $13 from $21. Keith writing in a note that he is becoming, quote, less confident in management's ability to achieve their long-term growth and margin targets. Now, he said share upside is limited as reports questioning the company's management credibility could be an overhang on the stock for another few quarters. And the stock took a major hit in 2023, plunging over 40%. But we'll get a further look into the fitness sector overall with Crunch Fitness CEO Jim Rowley later this hour. Stay tuned. All right, coming up, is 2024 set to be an exciting year for ETFs? Americans seeing big relief in prices at the pump in 2023 and in the new year. The national average for regular fuel currently sitting at $3.09 a gallon. So just how low can these prices go in the new year? Yahoo Finance's Inez Ferre has those details. Some welcome relief here, Inez.
Yeah, that's right, Rochelle. Some welcome relief, though we will see some seasonality starting to kick in soon. So you are going to probably see the gasoline prices tick higher. But let's take a look at where they're at today, because we are seeing that gasoline prices, according to AAA, the national average is at $3.09. Just 1 month ago, you had the national average at $3.24. In California, you're still paying the most out of any other state in the U.S., with that average at $4.71 compared to $4.81 just 1 month ago. California has higher taxes, more regulations when it comes to its driving fuel. But where is it going this year? Well, most analysts that I have spoken with believe that gasoline will be, for the average for the year nationally, at around $3.49, maybe perhaps below $3.50. The EIA, the Energy Information Administration, that's the government data, they're expecting gasoline prices to average $3.36. The peak is supposed to come this summer. Andy Lippo of Lippo Oil Associates is expecting a peak of $3.75 this summer. Remember that in the summertime, you have the people that are just demand that's just higher. You have people that are going out more, driving more. And then in the late summer is when you are also seeing hurricane activity. So that is impacting refineries, and that's when you see the price spike higher. OPIS, Tom Closa of OPIS told me that you can expect the sub-3 level for some states. Right now, about 28 states are seeing their gasoline averages below the $3 per gallon level. You can expect those to start to disappear within the next 100 days and to kick back in at the end of the year with the winter grade and lower seasonal demand. Look, when it comes to gasoline prices, last year, the EIA just put out this figure today. The average for last year was $3.52. That's 43 cents below what it was in 2022. A lot of that had to do with oil prices. Last year, you saw oil prices down for the year about 10%. Remember, though, this is an election year, so the government will want to keep these gasoline prices lower during election year. The Biden administration very focused on keeping gas prices lower. So, yes, you can expect to see some this continued relief for a little bit, but you're going to start to see seasonality, regular, typical seasonality, start to kick back in, sending prices a bit higher. Guys, Rochelle?
Yeah, and you know we'll be watching that closely in an election year. Seeing those numbers 3 foot high when you're driving in and trying to count your coins, of course. Inez, thank you as always.
Thank you.
Well, there was strong demand for fixed income ETFs in 2023, and S&P 500 base ETFs led that charge. Our next guest says last year investors were focused on higher quality investments in the ETF space, and this year could be one of the most dynamic years for ETF investors. So how do you pivot your portfolio from here to get the most out of this space? As part of our ETF report brought to you by Invesco QQQ, let's bring in Todd Rosenbluth, Verify Head of Research, to discuss this more. Welcome back to the show, and of course, a happy new year to you. So this pivotal year for ETFs, what will it look like?
Well, we had, as you mentioned, a really strong year in 2023. Equity ETFs led the charge in the fourth quarter. We had $100 billion back to back for overall ETF space in November and December. We think it's going to be different, as you mentioned, in 2024 for a couple of reasons. One, we'll dive deeper into it. We're likely to have the first of many spot Bitcoin ETFs begin trading in the coming days and weeks. And we're very excited about that at Verify. And then also, we think as the Federal Reserve is going to be adjusting its policy, we could see more value-oriented strategies will do better than they did in 2023 because of the shift in the environment.
So I do want to get to the spot Bitcoin ETFs. We've seen a number that are expected to get approved. Obviously, still haven't had anything confirmed yet. The so-called Cointucky Derby, can't claim credit for that, saw it online. But of the ones that are going to be coming out, because they're likely to be approved as a group, how do you decipher which are the best paths to follow? Which are the best investments to follow in that space?
Right. So what's interesting about the spot Bitcoin ETFs that we at Verify think are likely to come to market in the coming days and weeks, and certainly by February when we have the exchange conference, we'll have multiple products that are trading. You've got ways to choose ETFs based on fees. We have a couple of providers that have come out and talked about how low cost or the fact that they're making fees free for the initial 6 months or so before the ETF hits a certain threshold. You also have some of the established providers like Bitwise and Grayscale, which has a trust that could be converted into an ETF. Those are some of the players. And you've got established asset managers like Fidelity and BlackRock and Van Eck that are part of the mix here. So lots to focus on. And we at Verify are excited. In fact, we have a crypto symposium taking place coming up next week. Folks can visit ETFtrends.com to learn more.
We certainly be taking a look at that. I mean, we did see obviously some of the tokens themselves selling off on some mixed reports as to whether or not the SEC was going to approve these spot Bitcoin ETFs. But for people who have been looking at perhaps less riskier options, of course, the Magnificent Seven, the ones that have performed the best in 2023, how are they going to perform as we're sort of starting to see some questions potentially about valuations, given what we've seen with that downgrade from Apple by Barclays?
Yeah, we had a great year for growth stocks in general in 2023, and some of the more growth-oriented ETFs like Vanguard Growth VUG and the iShares Russell 1000 Value and Growth, iShares Russell 1000 Growth ETF had 40% gains for the year. So we do think more value-oriented strategies are likely to do better in 2024. Financials, energy, consumer staples, those are some of the sectors that have held up better. They do relatively well in a different interest rate environment that we're likely to see in 2024. And we're excited to see that investors have those options. They can look at iShares Russell 1000 Value or the Vanguard Value ETF to be able to pivot their portfolio, take some of the profits that they had in 2023 and rotate into 2024. And we could see dividend-oriented strategies do well also. So there's one that we like, SDOG, the Alps Sector Dividend Dog ETF, SDOG. It just recently went through its annual rebalance, focusing on the highest dividend yielding stocks across 10 different sectors. It's really a good ETF to take a closer look at.
Always appreciate your tips. Todd Rosenbluth, Head of Research at Verify. Thank you so much for joining me this morning.
Thank you.
All right, you're very welcome. All right, coming up, GM is out with its latest sales numbers. We dive into those next. General Motors releasing its fourth quarter and full year sales results today. To break down the numbers, Yahoo Finance reporter Pras Subramanian is here. And Pras, what a year it was.
Hey, Rochelle. So yeah, we see the stock dipping down a little bit here, but I don't think it was a bad quarter considering the fact that we had some remnants of the auto UAW strike that affected production there. So for the quarter, GM says overall sales were up 0.3% compared to last year at 625,000 vehicles. Standouts in the quarter include the Buick Enclave SUV, Encore GX, Chevy Equinox SUV, Camaro of all cars, and also GMC Sierra pickups. For the year 2023 overall, sales are up a healthy 14.1% to 2.95 million vehicles. GM says it's the number one seller in the U.S. overall for automakers in the U.S. and the number one overall full-size pickup seller in the U.S. with 841,000 full-size pickups sold. For the overall industry, a lot of the automakers will predict a annual average run rate for the entire industry in the U.S. and GM says that they're forecasting a 16 million annual unit sales rate for the U.S., which is pretty strong compared to pre-pandemic years in the past. Also, separately, GM earlier today announced that it'll offer $7,500 incentives for the EVs that lost the federal tax credit status due to the changing rules for battery components that the federal government implemented at the start of this year.
And Pras, we know a lot of people were sort of scouring those lists, wondering or not whether the cars that they were eyeing were going to qualify for a credit. Interesting move here by GM. Do you think any other companies will follow suit?
Yeah, I think that's going to be the next thing to watch is what other automakers like Ford, who lost the credit for their Mach-E, or Volkswagen, who lost the credit for their ID4 EV SUV. Are they going to sort of maybe potentially add that incentive now, knowing that they can maybe potentially change their sourcing to get those battery components up to speed from what the U.S. wants? So we'll see what the other automakers follow suit there. But I think they might actually do that because that is a huge loss from a tax credit point of view.
Indeed, I mean, $7,500, that's not a small chunk of change. Appreciate you getting us up to speed. Our very own Pras Subramanian. Thanks so much. All right, coming up, Secretary of Transportation Pete Buttigieg joins us to discuss the state of our supply chains, airlines, and more. Keep it locked here on Yahoo Finance.
All right, welcome back to Yahoo Finance. And the clock is ticking on a potential government shutdown, and with it, potentially havoc to the country's transportation industry. Let's get right to Transportation Secretary Pete Buttigieg for more on this potential impact. Mr. Secretary, it was nice to see you here. So your agency has had a couple good wins recently. Of course, the fine on Southwest, lower cancellations. But if there is a shutdown, how does that impact the broader transportation industry?
Well, it would really stop us in our tracks on one of the most important things we're doing right now, which is growing the workforce of air traffic controllers. There's been a lot of coverage recently about the stress that our controllers are under. The total number of the ATC workforce has declined year after year after year for decades. We finally changed that. We're finally growing the number of air traffic controllers, hiring faster than people are retiring or leaving. But a shutdown would immediately close the academy. It would stop the training pipeline, and we would immediately begin losing ground. So that's just one of many examples from the transportation space alone about why America doesn't need a shutdown right now. And the last shutdown drama cost a lot of time and effort and energy and money just getting ready for the possibility of that. We really should not begin 2024 with House Republicans threatening to do it yet again. It doesn't serve any meaningful policy objective, and it would send us in the wrong direction right after, as you mentioned, we've seen some really good results. Last year, you look at the cancellation rates, they're at a 10-year low. And we turned that around quickly after everything that our airspace went through in the prior year. We're making good progress. I can't guarantee that progress would continue if House Republicans force this kind of completely unnecessary shutdown in a couple of weeks.
Mr. Secretary, I think a lot of investors, at least that are on Yahoo Finance, are just continue to ignore the potential for another government shutdown under the thinking as something will get done. As someone that has been through this series of events before, what's the probability there is in fact a shutdown soon?
Well, look, I left the office on Friday afternoon last time in the fall, pretty sure that we were facing a shutdown, and over the weekend it got resolved. So it can happen, and it should happen that it gets resolved, but it should never get that close in the first place. And look, frankly, it seems like the likelihood of it going to shutdown is worsened by many of the dynamics that we've seen in the last few months. There has to be a way to head that off, especially because nobody around the country wants this. I mean, this is not something that the American people are looking for their elected representatives to do. On the contrary, there's an expectation that Congress will do its job, fund the government, and allow us to do things like fix ports that are important for our supply chains and inspect railroads to keep them safe and grow our air traffic control workforce and all the other things that people expect from our department alone. This is not a game. This is not an exercise. This is real life. This is our actual government, the only one we've got in the United States, our one federal government with some very important jobs to do. And frankly, the people, I mean, just thinking of the 55,000 or so men and women of this department, have better things to worry about all day as they look after American transportation safety than worry about whether they're going to get paid in 2 weeks.
And Mr. Secretary, some really jaw-dropping photos out of Japan. Of course, two planes colliding there, I believe it was yesterday. Some concerns on if the planes were properly communicating with the control tower. What do you say to Americans fearful that because of the shortage in air traffic controllers that we can see a situation like this?
Look, those horrifying images demonstrate just how important aviation safety is and why we work so hard to maintain America's record as the safest, most complex aviation system in the world. Flying remains the safest way to travel in the United States of America, and we don't take that for granted for a minute, to the point that in the absence of having had a fatal airline crash in more than a decade, we look at the close calls. Anytime something came even close to potentially maybe leading to an incident, we look at those close calls the way we used to look at crashes. And of course, we also look at things that are happening around the world outside the U.S., which is why the FAA will pay close attention to any and all lessons learned from what obviously is still unfolding in terms of getting the facts and the information about what happened in Japan.
Since we last talked, Mr. Secretary, Tesla has recalled almost all its vehicles it made, 2 million vehicles. They have since put out an update to their autopilot software. Now, I recently caught a Washington Post story review of this new technology, and their takeaway was it's still not safe, and people should not feel safe that Tesla vehicles with autopilot are on our roads. Should these cars do they need more updates? Should they be on the road altogether with this technology?
What I say is any time that our department finds a safety concern, that can lead to a recall. And in this case, there was a recall to improve the safety of this technology. What you have here is a situation where you have what's called level 2 automation. It is designed and intended to make a car safer, but if you rely on it too much, if you forget about the fact that no matter how advanced your car is, any car you can buy today requires that you have your eyes on the road and your hands on the wheel. And any car that doesn't ensure that, that can be a safety concern, to the point that we expect and require that vehicles have measures that prevent any kind of foreseeable misuse. In terms of going forward, obviously, if there's any concern going forward with this or any vehicle, NHTSA, our National Highway Traffic Safety Administration, takes that very seriously, and there is the potential for further corrective action like a future recall. What we're seeing now is that increasingly the recalls are around not just hardware but software. The good news is often a software-based recall is simpler to administer than a hardware one. But whether it's hardware, software, or the way they interact with each other, we're always going to be acting to make sure that our cars get safer. You know, we're just talking about aviation safety, where we work so hard to make sure that we maintain 0 as the number of passenger airline fatalities in a given year. We need to adopt that as our goal for roadway safety too. And that's a long, long way from where we are today. Today we lose the equivalent of a 737 every single day on our roadways, which is why we need not just safer cars, but safer roads, safer drivers and people, safer vehicles, all of that, safer speeds, all of that adds up to saving potentially thousands of lives in America every year.
Of course, Mr. Secretary, you and President Biden have championed EVs in this country, rolling out key legislation like the Inflation Reduction Act. Now, former President Trump is eyeing potentially gutting this, pulling back those incentives. Major automakers have invested a little more than $100 billion to roll out EV and infrastructure in this country. If those incentives are pulled back, given whatever may or may not happen come election time, how destabilizing would that be for America's auto industry?
Well, a radical policy shift like that would dramatically undermine the American auto industry at the very moment when there have been so many gains in a made-in-America EV revolution under the Biden-Harris administration. Look, the reality is former President Trump allowed China to build a major advantage in EV batteries and EV manufacturing at the very moment when it began to become obvious that EVs are going to be the future and that we can't keep people trapped in gas cars any more than you could keep phone users trapped on landlines for the next 100 years. That the industry has a very clear direction, and our policy has been to make sure that that EV industry is made in America. Undercutting American auto workers and auto companies with that kind of policy shift is the exact opposite of what this country needs, especially in a place like the American Midwest where I come from, where I see communities that made their original prosperity happen on the strength of the auto industry as it was 70 or 90 years ago, now seeing jobs created with EV battery facilities and other things related to the new technology. Trying to move America back toward old technology is a recipe for job loss and failure.
All right, we'll leave it there. Transportation Secretary Pete Buttigieg, grateful for your time as always. Happy New Year to you and the team. We'll talk to you soon.
Thanks, same to you. Take care.
Thank you. All right, Rochelle, back to you.
All right, thank you. Yahoo Finance's own Brian Sozzi and Pete Buttigieg, U.S. Secretary of Transportation. Great discussion there. All right, well, Apple hit its lowest level in 7 weeks after Barclays issued a rare downgrade on the stock, citing weaker demand for the iPhone 15. But Goldman Sachs sang a different tune this morning, saying the tech giant could stand to benefit from PC demand recovery. And with Apple's much-anticipated virtual reality headset expected to be released this year, what should investors expect? Yahoo Finance's Dan Howley joins us with the details. Dan, it seems like a lot riding on this year.
Yeah, that's right, Rochelle. We're seeing this, obviously this note from Barclays yesterday impacting the stock price, sending it down about 3% throughout the day yesterday. And now we're seeing this kind of, as you said, the opposite side of the coin, this Goldman piece saying that essentially an increase in PC demand will help Apple. And so, one of the weaker portions of Apple's business has been the Mac and iPad side of things. And that, like other PC manufacturers, comes down to when people purchased tons of new products as the pandemic kind of kicked off. It's been about 4 years since the pandemic, and people are in that refresh cycle where they're going to go out and buy new products. We'll be seeing that as PC sales start to kind of pull back up. There's been different reports from Gartner and IDC essentially saying the same thing, that the slowdown is starting to come to an end and we'll see a return to growth in 2024. So that should really benefit Apple and its Mac and iPad business. We're also, there's been rumblings about new iPads coming. And the Mac line has been refreshed with Apple's M3 chips. And so, these are kind of the kind of boons that they're looking for. This, they're going to potentially see this kind of reinvigoration of those segments. And oh yeah, they're running with really new processors. And so that's something that I think a lot of people are going to be interested in. The flip side of that is, Apple's computers tend to last a long time. And so people don't necessarily need to upgrade them as often as they may other PC makers. So that could be a problem for them. But this is going to be, I think, a year where Apple starts to kind of regain that strength in the Mac and the iPad business.
And it's interesting when you consider the slump that we saw in PC sales, and as you mentioned, IDC predicting global PC shipments forecast to recover in 2024. You don't usually think of, obviously a lot of people still use, Apple's laptops, but how do you see them gaining market share from that? Is it just about perhaps people getting that refresh, as you mentioned there, even though price is still relatively high versus, say, getting a Microsoft PC?
Yeah, prices are very high compared to getting a Windows PC. Although, all things being equal between the capabilities of one and the capabilities of the other, the prices are relatively equal. They just don't sell the entry-level devices that you would get from a Windows PC. But we were talking. You mentioned earlier the Vision Pro headset, and I think the question is, where is that going to fit in Apple's business segments? Right? Is that going to be part of the computer segment? They do call it a spatial computer, not a headset. They refuse to call it a headset. So will it be part of the Mac segment? Will it be part of the wearable segment? It could give a boon to the Mac segment if it slots in there, because it is a computer. Likely it'll be in the wearables because you're going to wear it on your face. And I think for Apple at first, it's not going to be a volume seller. That's basically just known now. $3,500 is going to be expensive. So I think when it does hit, it's going to make a splash. It's not going to be in a lot of people's houses, though.
True, that it does seem to be more so for the early adopter who's going to take this on. But you never know. That price tag, though. But you never know. I might be open to it. I might. Dan Howley, always great to get your take on all things tech. Thank you so much. Well, $743 billion worth of merchandise was returned last year. That's according to a report by the National Retail Federation. Now, returns don't always go back to the shelves, and they can be a massive expense for retailers. So what can be done to cut costs? Well, a startup is trying to make it cheaper and faster to return. Pollen Returns streamlines the process for consumers and reduces shipment costs for retailers by using logistics operators to schedule pickups directly from locations. To tell us more, Christian Piller, Pollen Returns co-founder and chief commercial officer, is here. Thank you so much for joining me this morning. So first, I want to talk about this record number of returns that we saw, obviously with the growth of e-commerce. But you say potentially what we see with returns could start to taper off this year. Why is that?
So with the continued growth in e-commerce, right, in the U.S. is a $1.5 trillion opportunity of 8.8 trillion global industry. So with the rise in e-commerce, we see a rise in returns. Consumers are starting to be frustrated by the returns experience. It's old, it's archaic. They have to find a box, they have to find a label. It's just getting harder and harder for consumers to continue to jump through the hoops that retailers put in front of them to return their items.
And for a lot of people, whether it's free shipping or seeing a return policy that seems restrictive, that's enough to make consumers say, okay, I'm not gonna click buy on this. How do retailers strike that balance then between still encouraging people to shop while also trying to make it a consumer-friendly return experience?
There are two main ways to do it. One is offering the consumers the opportunity for an instant exchange to get the item they want, be it size, or color. The other opportunity is to make it as customer friendly and convenient as the delivery experience, enabling consumers to schedule a pickup of just the item, so they don't need to go into a UPS or FedEx store, or go into a retail location, don't need to find a box, don't need to find a label. Making the delivery experience as seamless and convenient as the delivery experience is the new opportunity.
And in terms of the returns that people make ending up back on shelves, a surprisingly low amount actually makes it back on shelves. Walk us through that and why so few make it back.
So a very small percentage, some estimates say it's about 20% of returns actually make it back onto the shelf. The rest of the returns go to liquidation or they go to landfill. The main reason for that is that there's hundreds of millions or billions of dollars of retailers' inventory sitting on the coffee table by your front door or in the trunk of your car, just waiting for someone to take it somewhere. And the reason why it ends up not getting back to a shelf is it's out of style, it's out of season, or the retailer just bought new inventory and sold that instead of going through the archaic process of opening the box, inspecting it, and sending it back somewhere to get back on the shelf.
So talk about some of the investments that you're making to get a better track of the consumer and the logistics. I remember I had ordered a massage chair. 2 of them came by accident. And I was like, oh, Amazon, I was like, I don't need this. And I guess the cost of shipping it back was too much. And they were like, just go ahead and hang on to it. So talk us through how to make this perhaps an easier experience on the logistics and perhaps how you're using AI to better track some of these returns.
Yeah, so the returns is if we're able to put multiple items into one box and then ship that box, it's just cheaper and faster, right? It's more convenient, it's greener. When we think about what we're doing with AI, we take a picture of the items at the consumer's doorstep, and that's when we start that grading process. Is it a brand new pullover that hasn't been worn? Okay, yes, let's send it to one location to be immediately resold. Is it an item that looks like it's been worn? The tags are bent or it's dirty. Well, we have to send it somewhere else for another inspection and potentially either send it back to a shelf to be resold or to liquidations.
And obviously, we have to talk about the carbon footprint of all of this. I mean, when you saw all the packages over the holiday season everywhere, and then you couple that with returns, perhaps people either mailing it in or driving to mail it in, what do people need to understand about the sort of footprint that this leaves and how retailers can try and offset that?
Yeah, I think retailers that have a dedication to sustainability, if they're saying they have a sustainable goal, net carbon zero by 2040, 2050, they really need to focus on returns. 25% of GHG emissions for retailers are in the returns. That could be corrugated cardboard boxes. It could be driving packages, the consumer's driving packages to a location, or the transportation that happens from that location to product disposition. So if we streamline the front end where we have optimized routes, putting multiple items into a single box and less boxes being shipped, we start to reduce the carbon emissions of returns and get to something that's a more circular economy that we've all read about in business school.
So then what does the next evolution of returns look like for a consumer and for some of the retailers and customers that you work with?
It's a lot more digital than it is now. One of our customers we enable QR codes with them. 60% of their consumers choose the QR code over a printed label. And those consumers are delivering their returns back faster to the retailer. So the retailer has a better opportunity to get those products back on the shelf. What needs to be done is retailers need to update their returns processes and systems to make it as seamless, as convenient, and as efficient as the delivery experience that we've all come to get used to. Same day delivery, next day delivery, a subscription for anything. The next frontier for strategic focus is returns.
We'll certainly be tracking that, no pun intended. Thank you for joining us this morning. Christian Piller, Poland Returns co-founder and Chief Commercial Officer. Thank you so much.
Thank you.
All right, coming up, let's get physical. We talk the wellness market with Crunch Fitness CEO on the other side of this break.
Good morning, Wall Street. Straight from Yahoo Finance's front page to your mobile phones and to your streaming apps. Watch our new flagship show, The Morning Brief, your first stop as we guide you through the day's market action.
We give you insights into the latest market-moving news, real-time analysis of today's top stories,
and actionable information about your investments.
We bring you the opening bell on Wall Street. And don't miss our strategy sessions with Wall Street's top analysts.
It's the Morning Brief.
It's the Morning Brief.
The Morning Brief.
Yahoo Finance's Morning Brief, empowering you to make smart investing decisions. Tune in daily at 9 a.m. Eastern.
If exercising more is back on your New Year resolution list, well, you're in good company. Data compiled by Statista Consumer Insights found 50% of Americans have that same goal for 2024. Yet, over half of Americans give up their resolutions by March. So how does the fitness industry keep pace as consumers have more options than ever? Let's bring in Jim Rowley, Crunch Fitness CEO, to discuss more. Thank you so much for joining me this morning. And of course, in your 35th anniversary here of being in business here, talk about what we tend to see in terms of people signing up and the sort of subscriptions they go for when it comes to the start of the year.
Well, it's really goal-based. Well, first of all, thank you for having me and a Happy New Year. As far as what they're signing up for, their subscriptions, it's really goal-based. So some people want to obviously lose weight. Some people want to gain strength. Strong is the new skinny, especially with women. So people want to get stronger. Some people are looking for general health, and other people are looking to de-stress their life. So we offer breath work classes, we offer meditation classes, we offer high cardio intensity classes as well. So we like to say we've got everything under one roof at Crunch.
And certainly when you think of where we were pre-pandemic versus, a lot more online options, some remote options as well, how has that affected how you're pricing some of your offerings?
Our pricing stayed relatively similar. So we've got gyms that offer memberships as low as $9.99 a month. And then in our deep urban centers, like in Manhattan, we can be as much as $150 a month. It's really dependent on the region. It's dependent on the cost of doing business and so forth. And we try to be affordable for everybody. Back to being the original No Judgments gym, we know that not everyone can afford the most expensive membership. So we've got membership prices that allow everybody to enjoy Crunch.
And I mean, we obviously did see during the pandemic, a lot of people pulled back as they weren't able to access gyms. Obviously, the more loyal people who tend to be consistent did end up coming back. But how do you expand and really welcome a new audience into what Crunch is evolving into now?
Well, we've got our brick and mortar option, which is north of 360 gyms in the U.S. right now. But we also have Crunch Plus, which is a digital option, which has over 200 choreographed classes. We choreograph them ourselves. They're not bought from another agency and so forth. And again, it's having mass appeal. So there's a class on there that I actually helped create called Old Man Stretch Club, right? For men like myself that need to stretch more. We've got meditation, breath work, high intensity cardio. We've got short-term workouts. Maybe they're only 10 minutes long just to get you started, because we believe that just starting for many people is the hardest part. So we've reduced the amount of time necessary just to get that exercise going, get the heart rate flowing and so forth.
Let me know when you do a Mum's Getting 8 hours of sleep a night class. I'll definitely sign up for that. I do want to ask you about the labor market, though. In terms of employment retention, how tough has it been post-COVID? And what are you really incentivizing if people who perhaps want to get involved in fitness aren't sure if perhaps working in fitness is for them?
Yeah, it's a great question. So we actually just completed a team member engagement survey, really trying to ask the teams, what's critically important for them and how we can improve as a company for our more than 3,000 employees and so forth. And I'm also excited to share with you that one of the things that we'll be launching this year as a team member benefit is a 401k plan. We haven't had the scale, we haven't had the mass, we haven't had the ability to do so in the past, so we're excited to launch that. But really for us, it's about attracting team members who understand the lifestyle as well, that maybe sitting behind a desk for 7-8 hours a day, 10 hours a day isn't for them. Maybe being a realtor isn't for them, but incorporating their lifestyle with their professional life is. So a lot of our team members tend to come from the membership ranks.
And Jim, just very quickly, as we're almost out of time, I have to ask you about the weight loss drug craze that we've seen from 2023. Is that something you plan on incorporating into your business, this sort of holistic approach to health?
Look, I think this weight loss look, I'm not a doctor, but I think it's kind of like the college admissions scandal to me. If it's that easy, then everybody would be doing it. But there's a lot of regret that comes from it, right? So Ozempic, as an example, I think is about $1,000 a month. That's nearly 10 years of membership at Crunch Fitness on our base membership. So what we are seeing is that there are some downsides to the drug that affect muscle wasting and so forth. And we're here to help you build your muscle at Crunch.
Appreciate you taking the time to join us as we launch in the new year here. Jim Rowley, Crunch Fitness CEO, thank you so much.
Thank you very much.
All right, well, that does it for now. I'm Rochelle Akufo. Stay with us on Yahoo Finance.